The Wealth Playbook, a street-smart guide to building wealth, starting today 1. The system is rigged. Why it feels rigged. The wealth gap in America is staggering. As of 2021, the top 1% held about 31% of all wealth, while the bottom 50% own just 2.6%. Upward mobility is tough. A child born poor has only a 1% chance of reaching the top 5% income bracket, whereas a rich-born child has a 22% chance of staying rich. Many workers feel the game is stacked. 77% of U.S. adults say they aren't financially secure. Stagnant wages against rising living costs make it hard to get ahead. It's no wonder over 47 million Americans quit their jobs in 2021, a record Great Resignation, driven partly by frustration with the conventional 9-5 grind. The default path often leaves people one emergency away from crisis. The system's default settings favor consumption and debt, not wealth building. 1, 2, 3, 4 case studies beating the odds. Despite the odds, ordinary people are cracking the code. Anthony Vicino started a decade ago living in a van with $80,000 in debt and barely minimum wage income. By learning the money game, he turned $7,500 into $80 million of real estate over time. Similarly, Vermont janitor Ronald Reed quietly amassed an $8 million fortune by investing in blue-chip dividend stocks, living frugally, and holding for decades, proving you don't need a high income or rich parents to build wealth. First-generation Americans are succeeding too. For example, immigrant entrepreneur Lowell Hawthorne arrived with nothing and eventually built a $100 million food franchise through grit and calculated risks. These stories show the system can be beaten by playing a different game, investing early, taking smart risks, and leveraging opportunities that most ignore. 5, 6, 7, 8 Psychology and behavior, rewiring your mindset. Feeling like the system is rigged can create a scarcity mindset that saps your mental energy. Research shows financial stress taxes the brain. Worrying about bills can cause a 13-point IQ drop, akin to losing a night's sleep. This tunnel vision leads to short-term decisions that keep people trapped. To beat the system, we must break out of this mental trap. Start by shifting to an abundance mindset. Believe that wealth is attainable with the right steps. Use automation and default effects to your advantage. For example, when saving is the default, people succeed far more. Companies that auto-enroll workers in 401 plans see 82% participation versus 55% in opt-in plans, proof that designing your environment can override willpower failures. Recognize the power of compound growth as your ally. Most people underestimate exponential growth and thus underinvest. But a small amount invested regularly can snowball. Even $5 a day at an 8% return grows past $500,000 over 40 years. Lastly, challenge the belief that you must work till you die. As investor Warren Buffett famously said, if you don't find a way to make money while you sleep, you will work until you die. In other words, owning assets is key to escaping the paycheck cycle. Tech visionary Naval Ravikant echoes this. You're not going to get rich renting out your time. You must own equity, a piece of a business, to gain your financial freedom. Embrace that mindset shift. 9, 10, 11, 12, 13, 13, 14 Light on AI. The rig system is also evolving. Automation and AI are changing the rules, potentially displacing many jobs, but also creating new opportunities. One study predicts 25% of jobs face high automation risk by the early 2030s, but also that new tech could create as many roles. The takeaway, adaptability is crucial. Rather than fear AI, learn to leverage it. The system may be changing, but street-smart wealth builders will change with it. 15-16 action steps. Rig the system in your favor. Calculate your gap. Determine your wealth gap, how much more you need to earn or save to break out. Use a simple budget to see where your money is going. Automate and pay yourself first. Set up automatic transfers to savings investing on payday. Treat it like a non-negotiable expense. As Buffett advises, do not save what is left after spending. Instead, spend what is left after saving. Automation makes this easy. Leverage free knowledge. The wealthy exploit information gaps. Start reading one personal finance or investing resource a week. Knowledge is compounding too. Even 30 minutes of daily reading puts you ahead. Some great free courses on YouTube, Coursera, etc. can teach you high-value skills that increase your earning power despite the rigged wage system. Use default bias to your benefit. Make good financial behaviors the default. For example, Enroll in auto investing with a service like Vanguard or Fidelity. You'll hardly notice it after setup. Similarly, enable auto bill pay to avoid costly late fees. Small defaults like these accumulate wealth painlessly. Network and seek mentors. The wealthy play by insider rules, so get inside the circles. Join a local investing club, find a mentor at work or online. One introduction or piece of advice can shortcut years of trial and error. Don't be afraid to ask, how did you do it? Many successful people love to share. 17.18. Realistic timeline. Changing your trajectory isn't instantaneous, but you can see progress quickly. In one day, you can automate a transfer or 401 increase. In 1 month, you can complete a basic finance course or read a seminal book. Within 6-12 months, if you consistently invest and perhaps start a side hustle, you'll notice net worth growth and new income streams. Remember, compound interest favors the patient. Even if the system is rigged short-term, you win by playing the long game. 2. Breaking free from a 9-5 mindset. Rethinking the script. The traditional 9-5 job mindset says, get a stable job, work 40 years, then retire. But this company man path has frayed. Wages often lag inflation and job security is no longer guaranteed. In 2021, the average American job tenure was under 5 years, and mass layoffs and burnout are common. Importantly, a single paycheck is one income stream. If that dries up, you're in trouble. Breaking free means shifting from one-way dependency to multiple flows of income and time freedom. It starts with mindset, viewing your labor as a resource you can deploy in new ways rather than selling it to one employer at the lowest bid. The proof is in 4 trends. A record 5.4 million new businesses were started in 2021 as people sought independence, and by 2025, roughly 39% of working Americans have a side hustle to diversify income. The desire to escape the 9-5 is widespread. 1920 case studies, from employee to entrepreneur. Look at M.J. DeMarco, who left a respectable corporate job to pursue entrepreneurship in his 20s. Family and peers called him crazy, but he turned his back on the expected career path. Get up, go to work, come home. Then repeat day after day, as he put it, and built a multi-million business. He notes you often must break free of society's gravitational force, ignore the naysayers to find success. Another example, Jessica, a 32-year-old who felt stuck in retail, spent nights learning UX design online. Within a year, she landed a tech job at double the salary and now freelances on the side. Or Arthur, who pivoted into tech sales at 45. Starting as a junior sales development rep, he was earning $70,000 plus within a year, far above his old wage, and he relishes the performance-based pay. Even more radically, a movement known as FIRE has ordinary folks saving 50% plus of their income and quitting traditional work in their 30s or 40s. For instance, Mr. Money Mustache retired at 30 by living simply and investing aggressively. Now he works only on passion projects. These stories prove that exiting the 9-5 hamster wheel is possible with strategy and courage. 21-21-22 Psych plus money behavior. Ditching the comfort crutch. One big barrier is fear and conditioning. The 9-5 mindset is comfortable. We're taught to seek security, benefits, a steady paycheck. Psychologically, it's loss aversion. We fear losing the perceived security of a job more than we anticipate gains from striking out. But consider, 47% of Americans say they'd struggle to cover a $500 expense, yet many hesitate to pursue better opportunities due to comfort. Overcoming this means reframing risk. Ask, is it riskier to rely on one employer or to develop multiple skills and incomes? Habit formation plays a role too. If you've been doing 9-5 for years, it's a deep habit. Start small to break it, perhaps a 5-9 side project. As you experience small wins, your identity shifts from just an employee to entrepreneur-creator. Also, address the scarcity mindset that keeps people clinging to jobs, the belief that good opportunities are scarce. Replace it with an abundance mindset. Opportunities are everywhere. In surveys, 50% of millennials now have or plan side gigs because they've seen peers succeed independently. There's also evidence that job dissatisfaction can spur creativity. Feeling stuck can be leveraged as motivation to innovate a new path rather than fall into learned helplessness. And importantly, self-efficacy grows with practice. The more you step out of your comfort zone, the more confident you become that you can thrive outside the cubicle. 23-24 action steps. Expand beyond the 9-5. Start a low-risk side hustle. Don't quit your job tomorrow. Instead, test drive life outside 9-5 by starting a side income. Pick something attainable in your spare time, e.g. freelance your existing skill on Upwork, Fiverr, drive for Uber on weekends, or sell a craft online. 27% of U.S. adults currently have a side hustle. Aim to earn even $200, $500 a month at first. This extra income not only helps financially, it proves to you that you're not reliant solely on your employer. 25. Set a quit date or goal. If your goal is to go independent or change careers, give yourself a concrete timeline or financial target. E.g., I will quit my job by June next year, once I have $10,000 saved and $2,000 a month for my hustle. Having a target focuses your effort. Nearly 45% of side hustlers say they aim to turn their gig into a full business eventually. Whether or not you fully fire your boss, a target will push you to grow. 26. Reskill or upskill. Identify one high-income skill you can learn within 6-12 months that boosts your market value or enables freelance work. This could be coding, digital marketing, UX design, technical sales, even a trade like HVAC repair or welding. For example, CompTIA A+ certification can be achieved in 3-6 months for beginners and can lead to entry-level IT jobs $50,000. Similarly, a tech sales training program of a few months can land a $60,000, $80,000 SDR role. Block out a few hours each week for learning. Put on your calendar like a work meeting. 27. Build your exit fund. Financial runway equals freedom. Start aggressively saving an emergency fund or quit fund. Aim for at least 3-6 months of living expenses. This fund gives you the confidence to take career risks. Use automation to funnel part of every paycheck into a high-yield savings account or money market fund. Tip: treat this fund as untouchable for daily expenses. It's your freedom fuel. 28-29. Shift your work mentality. Starting now, approach your current job as a platform to build skills and connections, not just a grindstone. Take on projects that stretch you. Network with colleagues and clients. Practice entrepreneurship. This not only boosts your performance, but it mentally prepares you to operate more autonomously. Also, negotiate your time. If possible, negotiate a day of remote work or a compressed schedule. Use any gain time flexibility to work on your escape plan. Realistic timeline. It typically takes 6-18 months to pivot out of a 9-5 comfortably. For example, if launching a new career, many certificate programs run for 9 months. A solid side hustle might need 6 months to a year to reliably replace a chunk of your income. Expect to burn the midnight oil in the interim. You'll be effectively working double, which is taxing. But within 1 year, you could be in a vastly different situation, perhaps in a higher-paying field or working for yourself with a few steady clients. It's not instantaneous, but the time will pass anyway. You might as well spend it building your exit. Remember MJ DeMarco's advice: every day you spend building your dream is a day closer to freedom, while every day just punching the clock is renting your life away. Breaking free is a gradual process, but each step compounds. The sooner you start, the sooner your life becomes your own. 21-3. Control the flow, mind your money stream. Budgeting isn't about deprivation. It's about directing your money flow with purpose. Think of your income as a flow of water. Without control, it leaks everywhere and evaporates. With a plan, you divert funds to what matters and plug the leaks. The need is dire. About 77% of workers live paycheck to paycheck, such that missing one check would cause hardship. In 2024, only 46% of Americans could handle a $1,000 emergency from savings, meaning most would resort to credit cards or loans. Yet, about 30% have some discretionary income that simply gets absorbed by lifestyle creep or impulse spending. Controlling the flow means capturing those dollars before they escape. A budget is not a punishment. It's permission to spend guilt-free on what you value by cutting what you don't. Importantly, budgeting is the foundation that 30-31-32-33 enables every other wealth move. As personal finance expert Ramit Sethi says, spend extravagantly on the things you love and cut costs mercilessly on the things you don't. Budgeting reveals what those things are. 34 case studies, budgets pay off big. Courtney, a young mom, and her husband found themselves $90,000 in debt. They decided to budget every dollar and throw all excess at debt. In 21 months, they paid off the entire $90,000 and became debt-free. How? They tracked every expense, slashed dining and grocery costs, and even worked extra gigs, essentially living on a plan. They hosted potluck gatherings instead of footing entertaining bills and said no a lot. The result? Now they have breathing room and continue using those budgeting habits to stay debt-free. Another success, Jennifer had $30,000 in credit card debt. She met with a nonprofit credit counselor who helped create a strict budget and debt management plan. By sticking to it, cutting subscriptions, selling unused items, taking a weekend side job, she cleared the $30,000 in about 3 years. Her stress level dropped, and she said the key was automating payments according to her budget, so she lived on what's left after debt payments. On a different note, Dan was never in debt, but never saved either. At 35, he realized he had no emergency fund. He embraced the 50-30-20 budget rule and used an app to track everything. In 1 year, he went from $0 to $10,000 in savings simply by curbing mindless spending, proving that mindful budgeting can find money you didn't realize you had. These cases show that taking control of cash flow yields concrete results, whether paying off 5-figure debt or accumulating 5-figure savings. 35-36-37 Psychology and Behavior, the budgeting mindset. Budgeting is as much behavior as math. Default bias is huge. If you don't plan, the default is to spend until the account is empty. A telling stat, only about 32% of households maintain a formal budget, but those who do report significantly less financial anxiety. One reason people avoid budgeting is psychological pain of self-restraint, akin to dieting. But research on delayed gratification shows that those who practice self-control in money tend to have better finances. In fact, impatience and low credit scores are correlated. People who struggle to delay gratification often rack up debt. Knowing this, a budget can be reframed as a tool to reduce decision fatigue. Rather than saying no to every latte in the moment, you decide in advance how much goes to coffees, dining, etc. Then you simply follow the plan. This taps into the automation effect. By reducing daily choices, you conserve willpower. Behavioral economists also note the envelope system works because it creates tangible limits. A modern take is using separate accounts or apps with spending caps for categories. Another bias. Optimism bias leads people to not save, whereas availability bias makes spending more tempting. Combat these by consciously visualizing your future goals. It strengthens motivation to stick to the plan. One more factor: habits. Initially, tracking every expense is tedious, but studies suggest it takes about 2 months to form a habit to the point it's automatic. Many who successfully budget say that after 1-2 months, the routine of logging expenses or reviewing weekly no longer feels burdensome. It becomes second nature, like brushing teeth. During that habit-forming period, tools can help: budgeting apps, weekly reminder alarms, or an accountability partner. Finally, celebrate small wins. Behavioral psychology shows positive reinforcement helps lock in new behaviors. So if you stick to your budget this week, reward yourself with a fun treat, guilt-free. 38, 39, 39, 40, 41, 42. Build a bare-bones budget first. List your mandatory monthly expenses. Compare that total to your take-home pay. This is eye-opening. Then list discretionary spends. Identify 1-3 easy wins to trim. For example, if you have 7 subscriptions, could you cut 2 you barely use? Small cuts add up. Many find that just creating this bare-bones plan often frees $100, $300 they can redirect to savings or debt payoff immediately. Use a simple Google Sheet or a free app like Mint to get started. Track every expense for 30 days. This is the budgeting bootcamp method. Write down or log every single purchase for 1 month, no exceptions. This practice boosts awareness. People often discover invisible leaks. After 30 days, categorize and total it up. You'll likely be shocked by areas to cut. One person's 30-day tracking revealed $200 a month on vending machine snacks at work, which they curtailed and instead automatically moved $200 to an investment account thereafter. Pro tip: continue tracking beyond 30 days if you can. The longer you do, the more ingrained mindful spending becomes. Adopt the 50-30-20 rule. As a starting framework, allocate 50% of income to needs, 30% to wants, 20% to savings debt. If 30% on wants feels too tight or too loose, adjust the ratio. The key is assigning every dollar a job. If you get a paycheck of $1,000, for example, you might designate $500 needs, $300 wants, $200 to savings. This ensures you plan to save each pay cycle. Even if you can't hit the ideal ratio immediately, having targets helps. Importantly, move the savings off the top. If you pay yourself $200 first, you'll naturally constrain others spending to the remaining $800. Use tools and tricks to stick to it. Make budgeting easier with technology. Some suggestions: use zero-sum budgeting apps like Inab, which force income equals expenses, or envelope-style budgeting via cash or prepaid cards for categories. Set up text or email alerts from your bank for when you approach a certain balance, a nudge to slow spending. If you have trouble controlling credit card use, consider switching to mostly debit or cash for discretionary spending. The tangible loss of cash can curb overspending. Also, consider the $100 24-hour rule. For any unplanned purchase over $100, wait 24 hours before buying. Often, the impulse passes, saving you money. Prioritize an emergency fund. As part of controlling cash flow, make savings a non-negotiable expense. Aim first for $500, then $1,000 in an emergency fund. This fund stops life surprises from blowing up your budget. Automate a modest weekly transfer to a separate savings account. To turbocharge it, try a no-spend challenge, e.g. commit that for one weekend a month, you won't spend a penny on non-essentials, then put the amount you would have spent into your emergency fund. Nearly 1 in 4 people had to tap savings for basic expenses in the past year, so having this cushion is crucial. By treating saving as a bill, you ensure you live below your means, which is the ultimate goal of budgeting. 2843 Realistic Timeline. Budgeting impact can be felt quickly. Within 1 month of diligent tracking and trimming, you'll likely see your bank balance stabilize instead of mysteriously vanishing. Many people find after the first month that they saved a few $100s more than usual just by being conscious. In 3 months, you can build a $1,000 emergency stash if you save $85 a week, doable via cuts or a small side gig. Debts can start dropping too. One budgeting family managed to pay off over $10,000 of debt in their first 3 months by sticking to a strict plan and throwing every extra dollar at balances. Habit-wise, give yourself about 2 months for the budgeting routine to become comfortable. After 6 months of controlled flow, you'll have a clear record of your spending patterns and likely have eliminated a few bad habits. Expect that the first 1-2 months are the hardest. But by month 6, you may actually enjoy the process. Seeing debt balances plummet or savings grow becomes addictive. Remember, budgeting is not one and done. It's ongoing. But the good news is it gets simpler over time, especially as your financial health improves. Essentially, mastering your budget in the first year can set you up for decades of financial confidence, a worthy trade-off for a few months of intense focus. 4. Spend like the wealthy, the spending secrets of a rich. It's a popular image. Rich folks sipping champagne on yachts. But data shows most self-made wealthy people don't spend extravagantly on every little thing. In fact, they often spend strategically. The average millionaire is more likely driving a 5-year-old Ford than a brand-new Bentley. Consider 87% of wealthy people have never bought a new luxury car in their life. 67% of millionaires call themselves frugal, and a surprising 30% use coupons regularly. 8% even shop at thrift stores. The wealthy prioritize spending on assets and quality, not fleeting status symbols. Where an average consumer might finance the newest iPhone or eat out 5 times a week, a wealthy individual is more likely to invest in, say, a reliable property or stocks and be modest elsewhere. Spending like the wealthy means treating every dollar as an investment, either an investment in assets or an investment in your own happiness needs. They splurge on what provides value and skip or minimize the rest. As millionaire David Bach says, don't buy $300 shoes unless you've invested $300 first. The rich understand opportunity costs deeply. 44, 45, 46 case studies, frugal to fortune. Ronald Reed, mentioned earlier, epitomized stealth wealth. As a janitor with modest income, he carefully controlled spending, even mending his clothes with safety pins to avoid new purchases, which allowed him to consistently invest spare money. Result: $8 million net worth at 92. Another case, the Millionaire Next Door profiles found that many U.S. millionaires live in average neighborhoods, wear inexpensive suits, and spend far less than they could afford. Example: one such millionaire couple had a $5 million net worth, yet lived in a house worth under $300,000 and drove Toyotas for over a decade. Why? They funneled cash into investments and only upgraded things when truly necessary. On the other hand, there are stories like Jackie, who adopted rich spending habits to dig out of poverty. In her 20s with a low income, she read that wealthy people prioritize paying themselves first and buying quality to last. She stopped buying cheap fast fashion clothes monthly and saved up for a few durable outfits. Over 5 years, she saved $20,000 and started investing, simply by mirroring frugal habits of the rich. A dramatic story. Ronald Ramsey, a bus driver who never made more than $50,000 a year, amassed $1+ million in stocks by age 60. His method was to live on about $30,000 and consistently invest the rest. He still cut coupons and brown-bagged lunch daily even as his portfolio grew. These examples underscore that wealth is built by disciplined spending. 47, 7, 48, 44, 46. Interestingly, the wealthy also do spend lavishly in certain areas, but intentionally. Warren Buffett, worth billions, famously lives in the same modest house he bought in 1958 and has said, "I have every possession I want because I have what I value." He's frugal in daily life, but he'll spend on philanthropy and buying companies. Likewise, many millionaires splurge on investments or experiences rather than status items. Behavioral insights curbing lifestyle creep. A big challenge for many is lifestyle inflation. As income rises, spending rises in tandem. Wealthy individuals often consciously fight this urge. They essentially set a cap on their lifestyle, well below their means. Psychologically, this requires contentment and delaying gratification. The famous Stanford marshmallow experiment's lesson applies. Those who can delay the fancy car or bigger house and invest the surplus tend to end up wealthier. Indeed, one survey found 44% of wealthy people buy used cars every 5 years instead of new ones, delaying the gratification of that new car smell for long-term financial benefit. Another key behavior, value consciousness. The wealthy frame purchases in terms of long-term value. Is this expenditure providing utility or joy commensurate with its cost? If not, skip it. Many practice a 24-hour or 30-day rule on big buys. The psychology term here is hyperbolic discounting. We overvalue immediate pleasure versus future gains. The rich overcome this by having clear goals. If you know buying rental property in 2 years will make you $500 a month, it's easier to say no to random gadgets now. The default effect also comes into play. If you automatically invest raises or bonuses, you never see that money to spend. Some wealthy folks do this routinely. Additionally, consider social factors. Keeping up with the Joneses drives a lot of middle-class overspending. The wealthy next door often ignore social comparison. They might have millionaire friends still wearing $30 Casio watches. Cultivating a mindset of internal validation is a psychological marker of many self-made millionaires. They would rather be wealthy than look wealthy. As the saying goes, rich people stay rich by living like they're broke. Broke people stay broke by living like they're rich. 44. One more behavioral point. Automation to avoid overspending. For instance, some use separate checking accounts for bills and fund money. When the fund account is empty, they stop, an automated control. Also, leveraging defaults like contributing to retirement accounts before money hits your checking ensures you never consider that money available to spend. The wealthy essentially put their financial growth on autopilot so that their day-to-day spending is naturally constrained to a sustainable level. Action steps. Spend smart, not hard. Audit your last month's spending. Do a quick review of last month's bank credit card statements. Identify 2, 3 purchases that, in hindsight, didn't bring proportional value. Maybe $150 on takeout that could have been $50 groceries plus $100 saved or subscription services you forgot to cancel. This isn't a guilt trip, it's to consciously flag waste. Tally up those low-value spends. That's your found money to redirect going forward. For example, if you find $200 of fluff, note that as money to invest or pay debt next month instead. This practice mimics how the wealthy continually optimize their outflows for maximum value. Adopt the 24-hour rule for non-essentials. Train yourself to avoid impulse spending on anything over a certain amount. When you see something tempting, new gadget, flash sale, etc., force a pause. Put it on a 24-hour wish list. Often you'll find the urge passes, or the item isn't that necessary. This simple delay is something many millionaires do instinctively. If after the wait you still really want it, and it fits your budget, you can buy guilt-free. But you'll be surprised how much you don't by using this rule. Live on the 10X Rule 4 upgrades. Challenge yourself to only upgrade lifestyle components when your net worth or passive income grows by 10X the cost of the upgrade. For example, itching for a $30,000 new car? Make a pact to wait until you've increased your net worth by $300,000 or have passive income that covers the car's price. This forces you to keep lifestyle in check relative to wealth growth. It's an approach some wealthy individuals credit for keeping them from frittering away gains. If 10x feels too stringent, try a 5x or similar rule. The concept is to peg luxury spending to real financial progress. Value spend on quality and assets. Before any purchase, ask, does this purchase appreciate, depreciate, or is it consumable? Aim to channel more spending into things that hold value or even grow. For instance, spending $200 on good work shoes that last 5 years is better than $100 on ones that wear out each year. Similarly, consider diverting some want spending into asset spending. Example, instead of a $3,000 luxury vacation, perhaps spend $1,500 on a modest vacation and $1,500 to buy stocks or start a small side business. The wealthy often balance enjoyment with asset building. By consciously doing this, you emulate that strategy. Another tactic, whenever you do splurge on a want, tax yourself an equal amount into investments. Love a $5 latte daily? Fine, but put $5 day into an S&P 500 index fund too. It might make you reconsider the frequency of that latte, or at least build assets alongside. Track your net worth, not just budget. Wealthy people focus on net worth more than just income or expenses. Start a simple net worth tracker. When you spend on credit or deplete savings, net worth drops. When you save, invest, or pay down debt, net worth rises. Watching this number can gamify smart spending. For example, say your net worth is $0 and you want it to be $5,000 by year end. If tempted by a $500 gadget, you'll see that reduces your goal by 10%. This perspective shift, what impact does this have on my balance sheet, is how businesses and wealthy folks think. It encourages you to spend in ways that either maintain or grow your net worth. There are free tools like Mint, Personal Capital, or Empower that aggregate accounts and show net worth. Use that feedback loop to guide your spending choices toward those that act like investments in your life. Realistic timeline. Changing spending habits happens over months, but some benefits kick in quickly. Immediately, implementing the 24-hour rule or similar will start reducing impulse buys. You might save money in the first week. Within 1-3 months, you should notice your bank balance staying higher as you curb wasteful expenditures. It typically takes a full budget cycle to really adjust your spending patterns and see significant reallocation of funds. For instance, you cancel subscriptions and avoid retail therapy. After 3 months, you've saved maybe $600 that you used to blow without thinking. That's $600 now, perhaps sitting in stocks or paying off a credit card. In 1 year, the differences can be huge. Many who adopt frugal wealthy habits report saving 10-20% of their income, whereas before they saved near 0%. For example, if you earned $50,000 and were saving nothing, within a year, you could be saving $5,000 plus just by living more like the millionaire next door. Lifestyle creep is a constant enemy, so this is ongoing. Every raise or windfall, you'll consciously decide not to inflate lifestyle too much. But the longer you practice value spending, the easier it gets. By year 5, you might find you've avoided tens of thousands in needless expenditures, which are now growing your wealth. Remember, spending like the wealthy is a marathon, not a sprint. It's about consistent, smart choices. But even early on, you'll likely feel a new sense of control and satisfaction. You'll realize that missing out on some fleeting splurges doesn't hurt as much as the security and progress you gain. In short, the timeline to spend like the wealthy is continuous, but you'll see positive changes in your finances within months and major improvements within years, ultimately paving the way to financial freedom. 5. High-income skills and trades. Anyone can learn. Skill up for big bucks. In today's economy, what you do matters more than ever for your income. The good news is you don't necessarily need an expensive degree to earn a high salary. High-income skills and trades are accessible to ordinary folks willing to learn. These are skills in strong demand that command dollar hour, well above average. Think software development, IT security, digital marketing, sales, project management, graphic UI design, data analysis, or skilled trades like plumbing, electrical, welding, HVAC. The U.S. Bureau of Labor Statistics shows many trades jobs pay $50,000, $80,000 plus with far shorter training than a 4-year college. For instance, median electrician wage is about $62,000 and growing 9% this decade, often after an apprenticeship of 4 years. Similarly, roles in tech often pay $70,000, $100,000 after a year or two of focused training. The key is these skills are learnable by anyone with dedication. Age, background, or formal education are less important than competency. And the payoff is huge. Pivoting from a low-wage field to a high-income skill job can literally double or triple your income, breaking the cycle of living paycheck to paycheck. Instead of working harder for each dollar, you work smarter by increasing the value of your skills. 49, 50, 51, 52, 53 case studies from zero to high earner. Kevin M., 28, was earning $15 hour in a warehouse. In 2020, he decided to pursue cybersecurity. He studied nights for industry certs for about 9 months. He landed an entry cybersecurity job at $70,000. Now, a couple years later, he makes $90,000 and sees a clear path to 6 figures. Garrett Morgan, mentioned earlier, chose the ironworker trade over college. By age 20, he was earning $50,000 a year with benefits as an apprentice, out-earning friends in college. He'll become a journeyman soon and can make $80,000 plus with overtime, all with zero college debt. Another story. Jane, a 35-year-old single mom, worked as a secretary. She spent 6 months learning Salesforce CRM administration through online courses. That certification enabled her to get a remote job at $75,000, and she does side gigs setting up Salesforce for small businesses for extra cash. Mike, 45, was a truck driver who wanted a change. He noted the demand for welders in his area. He went to night school for a year to get welding certified. Now he's a union welder making $40 hour and enjoys better hours. There's also Arthur's case, pivoting into tech sales in his mid-40s. After a brief boot camp and a 3-month job search, he started around $60,000 plus commission, and within a year was breaking $80,000 by selling software. These stories underscore that anyone at any age can learn a new lucrative skill or trade and vastly increase their earning power in under a year or 2. The earn while you learn model of trades is also powerful. Apprentices in many trades get paid from day one. And in tech, even entry roles often pay decent and serve as springboards. 49, 49, 54, 22 mindset. Become a lifelong learner. A psychological hurdle is the belief, I'm not smart enough, or I'm too old for a new skill. The reality, any skill is learnable with the right approach. Research on growth mindset by Carol Dweck shows that believing you can improve is critical to actually improving. Adopting a growth mindset, tell yourself, I can learn this, it's just a matter of time and effort. Also, tackle the fear of failure. Changing careers or learning something technical might intimidate you. But frame it as experiments. If a course or path doesn't click, you haven't failed, you've gained clarity. Many people dabble in a couple skills before finding the one they enjoy and can monetize. Another tip, use micro goals to avoid overwhelm. For example, instead of I must become a programmer, set a goal to complete a 4-week coding intro course. Each small win builds confidence. From a behavior view, habit formation is key. Schedule regular learning time like it's a job. Same time each day, say 7, 8 p.m. study session, helps turn learning into a habit. On motivation, find role models. Hearing success stories can fuel your drive. Maybe join online communities of learners to keep you accountable and motivated. One fascinating aspect, self-efficacy tends to rise as you acquire new skills. That spills into other areas. You start thinking, if I could learn to code, maybe I can also learn investing, etc. It creates a virtuous cycle of empowerment. Meanwhile, societal bias sometimes devalues trades or career switching. Ignore that noise. Note that 84% of tradespeople report high job satisfaction. Many actually enjoy tangible work and good pay. And tech fields are celebrated now. Even free resources from big tech companies are available to help people skill up. 55. Finally, the default effect. The default for many after high school is either college or just sticking with whatever job they fell into. To break that inertia, intentionally opt out of default career drift and opt into skill building. It might require sacrificing some leisure, but you can also integrate learning into life. Listen to coding or marketing podcasts during your commute, etc. Action steps. Level up your earning ability. Research 2, 3 in-demand skills. Look at job boards or sources like the Bureau of Labor Statistics to identify high-growth, decent-pay fields that don't require a fancy degree. Examples: digital marketing, UX/UI design, software development, IT support, cloud computing, nursing or healthcare tech, electric line repair, plumbing, carpentry, automotive tech, CDL truck driving, etc. Pick a couple that interest you and research the typical training path. How long is it? What does it cost? Many have low-cost entry points. For instance, a Google Data Analytics certificate can open junior analyst jobs. A community college welding course might cost a few thousand, but leads to $50,000 plus jobs. Seeing the concrete path makes it real. Invest in a course or bootcamp. Once you've chosen a skill, commit by enrolling in a structured program. Free self-study is great, but paying for a credible course can provide curriculum and motivation. For tech skills, platforms like Coursera, Udemy, edX offer inexpensive courses for many high-income skills. There are also intensive boot camps. For trades, look into union apprenticeships or trade schools. For example, CompTIA A+ certification courses might run a few $100s and take 3-6 months of study. A coding bootcamp might be 12-24 weeks full-time. When evaluating, check outcomes. Action: this week, sign up for an intro class or workshop in your chosen skill, even a free one, to get your feet wet and signal your commitment. 27. Create a skill practice schedule. Treat learning like a part-time job. For instance, schedule 2 hours a day or 10 hours a week specifically for skill practice, and stick to it consistently. Use deep work principles. Eliminate distractions during learning. If life is busy, consider waking up an hour earlier or using lunch breaks. Many parents study after kids' bedtime. It's tough but temporary. Pro tip: focus on projects, not just theory. If learning coding, build small apps. If learning digital marketing, volunteer to manage social media for a friend's business to apply skills. Projects not only cement learning, they become portfolio pieces to show employers. Set milestones, e.g. by 3 months in, I will complete X project or earn Y certification. This keeps you progressing. Leverage free resources and communities. Supplement your formal learning with the wealth of free info out there. YouTube has tutorials on everything from plumbing fixes to Python programming. Join online forums or Facebook groups for your target field. Ask questions, learn from others' experiences. Websites like FreeCodeCamp or Apprentice.tv can be invaluable. Also consider finding a mentor or at least someone in the field for advice. For example, if you want to become an electrician, talk to electricians. Many are happy to share how they got started. For high-income corporate skills, LinkedIn networking is powerful. Find professionals in roles you want and politely reach out with a question or request for a brief call. People often oblige, and their guidance can shortcut your path. Start earning while learning. Whenever possible, monetize your new skill as soon as you're capable of basic work. This accelerates mastery and builds your resume. For example, if you're learning web design, take on a simple website project for a small client at a low rate. If you're apprenticing in HVAC, do small side jobs. If you're learning tech sales, maybe start affiliate marketing or selling something online to practice. Earning even $100 from your skill will boost your confidence tremendously. It validates that the market pays for this. Plus, any income can help fund further training or cushion a career transition. Don't wait for expert level. You only need to be one step ahead of a client's knowledge to provide value. Of course, stay ethical and don't overpromise, but real-world application is part of the learning. Many trades apprentices make 50% of journeyman wage from day one. Many freelance platforms allow beginners to find small gigs. Jump in. You'll learn faster by doing. 49. Realistic timeline. Building a high-income skill isn't overnight, but it's relatively short compared to traditional degrees. A 3-6 month timeline can often land you an entry certification or the basic skill set. Some paths may be longer. Apprenticeships in trades might be 2-5 years to become fully licensed, but note that you earn throughout. For example, in year 1 you might earn 50% rate, and by year 4 near full rate. Many tech or new-collar jobs can be landed within 6-12 months of dedicated training. For instance, someone with no background could go from zero to a junior web developer or IT support tech in under a year. Expect the job search to take another few months after training. So if you started today, you might realistically switch into a higher income role in about a year's time. For incremental improvement, the timeline could be shorter. Maybe a 3-month certification yields a promotion in 6 months. Importantly, don't be discouraged by starting at the bottom in a new field. Even if you take an entry job, the ladder in high-paying fields rises quickly. For example, an entry data analyst at $50,000 might become a senior at $80,000 within 2-3 years. A plumbing apprentice making $20 HR can be a master at $40 HR in a few years. One concrete timeline example. CompTIA A+ Cert. Get IT help desk job at $45,000 after 1 year experience. Get Security Plus Cert transition to cybersecurity analyst at $70,000. That's about 1.5 years from zero to solid salary. 6-18 months is a common range we see in many of these cases for significant income shifts. It requires focus and hustle, but it's a blink of an eye compared to struggling for decades in low-wage work. And the beauty is, once you have a high-income skill, it tends to compound. You continue learning and commanding even higher pay with experience. So if you commit the next year to skill building, you could set yourself on a trajectory of prosperity for the next 30. High-income skills are truly the gift that keeps on giving. 4950. 6. Investing 101. Make your money work for you. Investing is often seen as complex or only for the rich, but basic investing is essential for anyone seeking wealth. Why? Because you will never get rich solely by your own labor. You need to put your dollars to work even when you're sleeping. As Buffett quipped, if you don't make money while you sleep, you'll work until you die. The power of compound interest is astounding. For example, historically the U.S. stock market returns 7% per year after inflation. That means even small amounts grow significantly over time. $100 invested per month at 8% can become around $150,000 in 30 years. 59. Yet many Americans miss out. Currently, only 55 to 62% of Americans own stocks, meaning almost half aren't investing at all. And surveys show 71% couldn't answer a basic compounding question, indicating why people underestimate it. The starter pack for investing means focusing on simple, proven vehicles, things like index funds, maybe some quality dividend stocks or bonds, and tax advantage accounts like a 401 or Roth IRA. You don't need to be an expert stock picker. In fact, index funds outperform most individual stock pickers over time. The goal at this stage is to build the habit and confidence of investing regularly, even if the amounts are small. Over time, this habit can turn modest savings into a significant nest egg. 5657 1313 case studies, small starts to big finishes, and a first-generation college grad started investing with literally $50 a month in low-cost index funds at age 25. She automated it and increased contributions as she earned more. By age 40, her portfolio crossed $100,000, mostly from those steady contributions and compounding returns. She's on track for a 7-figure retirement fund by her 60s, all from starting tiny. Similarly, a Reddit user shared how he consistently invested since 1988. After 37 years of dividend investing, he achieved $1,000 per day in dividend income by his mid-60s. It took decades, but he essentially created a self-sustaining money machine for retirement. Ronald Reed is an extreme case. Investing spare change in dividend stocks over 50 years made him an $8 million net worth. On a shorter timeline, consider Joel, who in 2013 began putting $200 a month into S&P 500 index funds and also bought a few shares of big companies like Apple. 10 years later, those investments grew to about $45,000. Not enough to retire on yet, but Joel used that as a down payment on a duplex, which will further accelerate his wealth via rental income. A powerful program is Employer 401 matches. Maria always contributed at least enough to get her employer's match. By her mid-30s, her 401k had over $80,000, even though her own contributions were maybe $50,000. The rest was growth and employer money. That's basically a bonus nest egg. There are also stories like Ingrid, who at 22 started a Roth IRA with just $500. She set up auto deposits of $100 MO. By age 30, despite some market ups and downs, she had about $20,000. More importantly, she learned how markets work and didn't panic sell during a downturn because she saw it recover. Now she advises her friends to start early too. These cases illustrate a key point. You don't need to be wealthy to start investing, but you need to start investing to become wealthy. Even ordinary people with small contributions can accumulate sizable wealth given enough time and consistency. 58.7 Behavioral biases. Don't be your own worst enemy. Investing is as much about managing your own emotions and biases as it is about picking investments. Common pitfalls: loss aversion, feeling the pain of losses more than the joy of gains. This causes people to panic sell when markets drop. But historically, the market has recovered from every downturn given time. If you sell in panic, you lock in losses. The wealthy typically stay calm and even buy more during crashes. Confirmation bias can lead you to follow hype. Or herd mentality makes you chase trends, buying crypto at the top because 59, everyone's talking about it. A starter investor should stick to a boring, broad plan because boring works. Automation helps remove emotion. If $100 goes into your 401 every payday automatically, you're less tempted to fiddle with it. There's also exponential growth bias. As noted, people can't intuitively grasp compounding. They might start investing but give up after a year because the growth seems slow initially. They don't realize the big acceleration happens later. It's like the classic example. Would you take $1 million upfront or a penny doubled every day for a month? The penny doubling yields over $5 million by day 30 due to exponentials. Early on, growth is tiny but later it's huge, so avoid the bias of underestimating future growth. Recognizing this keeps you consistent. Another bias, overconfidence, thinking you can beat the market by stock picking or timing. The evidence shows even pros struggle to beat index funds long-term. So for starters, it's usually wise to invest passively rather than constantly trade. The passive route also frees up your time and reduces stress. 1313 also, watch out for fees. A 1 to 2% mutual fund fee sounds small but can eat a huge chunk of your returns over decades. Many beginners don't realize this and get sold expensive funds. Stick to low-cost funds. Finally, leverage positive behaviors. Set and forget investing via automation harnesses inertia in your favor. Mental accounting hack. Treat your investment contributions like a bill you must pay, not optional. This mindset ensures you prioritize it. And visualize goals. It may help to use an app to project how much your portfolio could be worth in 10, 20 years if you stay on track. Seeing that future number makes the invisible benefit of investing more tangible and can motivate you to stick with it. Action steps. Invest your first $500. Start with retirement accounts. If you have a workplace 401 or 403, at least contribute enough to get the employer match. That's a 100% instant return on that money. For example, if they match 3%, make sure you're doing at least 3%. Set it up so contributions auto-deduct from your paycheck. If you don't have a 401k, open an IRA. A Roth IRA is great for beginners. You can start a Roth IRA with brokers like Vanguard, Fidelity, or Schwab, often with as little as $0, $50 to open. Put in whatever you can, say $50 or $100 to begin. The key is opening the account now. It takes maybe 15 minutes online. This is your vehicle. You can contribute up to $6,500 a year in an IRA. Even if you can't hit that, contribute regularly. 60. Choose simple, diversified investments. For a true novice, target date retirement funds are a fine one-fund solution. These automatically hold a mix of stocks, bonds, and get more conservative as you age. For example, Vanguard Target Retirement 2060, if you're 25. Otherwise, consider a broad index fund or ETF, and S&P 500 Index gives you exposure to 500 top U.S. companies. A total stock market fund covers virtually all U.S. stocks. These funds historically return 7 to 10% annually over long periods. They go up and down in the short run, but they're solid for a beginner's core. If you want international exposure, there are total international index funds too. The big point, avoid trying to stock pick individual stocks at the start. It's fun but risky. Indexes are easier and safer for building wealth steadily. And keep fees low. When selecting a fund, check. 13. The expense ratio. Anything under 0.5% is okay. Under 0.2% is great. Low fees mean more of your money compounds for you. Set up automatic investments. This step is vital. If your brokerage allows, enable automatic monthly contributions from your bank to your investment account. For instance, $200 on the first of each month goes into your Roth IRA and buys your chosen fund. This implements dollar-cost averaging. You buy regularly regardless of market price, which over time can lower your average cost and remove the guesswork of timing. Automating also ensures you pay yourself first. If you can't do automatic for some reason, set calendar reminders to invest manually on a schedule. Treat it like a bill. Also, consider automatically increasing contributions when able. There are apps that round up purchases and invest the change. Those can augment your main investing, but shouldn't be the primary method since amounts are small. Still, every bit helps. 59. Build an emergency fund before risky investing. While investing is crucial, make sure you have a cash cushion for emergencies. Ideally $1,000 at minimum, more if possible. This prevents you from having to tap investments or go into debt if something comes up. Think of it as insurance for your investments. You won't be forced to sell stocks at a bad time because your car broke down. So, parallel to investing, keep adding to your savings until you have a few months' expenses in a safe place. With that safety net, you can invest with far less worry. 60-29. Educate yourself consistently. Make a habit of continually upping your investment knowledge. It will boost your confidence and help you avoid scams or bad decisions. Dedicate maybe an hour a week to read or listen on personal finance investing. Some starter books: The Little Book of Common Sense Investing, Millionaire Teacher, or I Will Teach You to Be Rich, which covers basic investing in plain language. Also understand basic terms: stocks, bonds, mutual funds, ETFs, diversification, risk versus reward, etc. There are free courses if you prefer structured learning. The more you learn, the less the stock market feels like a casino and more like a wealth-building tool. Crucially, learn about behavioral pitfalls, e.g., watching financial news daily can induce panic. Better to set and forget, and check your portfolio maybe quarterly. One metric to track: your savings rate. Try to increase that over time. Many FIRE folks target 30%, 50% or more. But start wherever you are and aim to raise it 1% at a time. Realistic timeline: when will you see results? In the first year of investing, the tangible result might be modest. You'll see account growth mostly from your contributions plus perhaps a bit of market gain. But you'll have achieved something critical. You've built an investing habit. That alone puts you ahead of probably 50% of people. Within 5 years, if you invest regularly, you'll start noticing meaningful compounding. For example, investing $300 a month at 7% could grow to about $21,000 in 5 years. Not life-changing yet, but solid. By 10 years, the compounding picks up. That same plan would be around $51,000. The curve starts to bend upwards. 20 years, now it's serious, roughly $154,000. Notice growth exceeded contributions by year 2059. 30 years, about $350,000. That's the magic of compounding. Most of the wealth came in the later years. The timeline is long, but remember, the earlier you start, the more years you give compounding. Even if you can't invest a lot now, those extra years of growth are priceless. Also, life timeline-wise, things like buying a home or funding kids' college can be midterm goals. For those, you might invest a bit differently. One thing you'll likely see sooner is dividends interest adding up. The first time you earn, say, $100 in a quarter from dividends, you realize your money is now earning money. As your portfolio grows, those dividends might pay some bills. Some milestones: hitting $1,000 invested, $10,000, etc. Each milestone tends to come faster than the last if you stay consistent and increase contributions when able. Also, every market cycle you go through will educate you. If a recession hits and your $5,000 portfolio drops to $3,500, it's scary. But if you hold on and see it recover to $6,000 the next year, you gain the confidence to weather bigger storms later with larger amounts. In summary, initial results might seem slow, but stick with it. By year 5-10, many people have the aha moment where growth becomes visible, and they're so grateful they began. As the saying goes, the best time to plant a tree was 20 years ago. The second best time is now. Plant those financial trees now, and your future self will enjoy the shade. Investing is the engine of wealth. Even a small engine can power you a long distance given enough time, so start that engine today. 7. Real estate without rich parents owning property on a budget. Real estate is a powerful wealth builder. It's tangible, provides shelter, and historically tends to appreciate over the long term. But many assume you need a big inheritance or trust fund to buy property. Not true. Thanks to programs like FHA loans and other first-time buyer assistance, regular folks with modest savings can buy a home or investment property with low upfront cash. For example, on a $250,000 house, an FHA down payment is $8,750. While that's still a chunk, it's far more attainable than 20%. In fact, the majority of first-time homebuyers put down less than 10% nowadays via FHA, VA, or 5% conventional loans. Even if you don't have rich parents to gift a down payment, you can save systematically or use strategies like house hacking, buying a 2 to 4 unit property, living in one unit and renting others. This way the rent helps pay the mortgage. House hacking is how many young investors get started. Data shows buying a home remains a key to wealth. Homeowners have a median net worth far above renters. And owning real estate gives you leverage. Real estate without rich parents means leveraging these tools and creative strategies to get your foot in the door of property ownership, even if you're starting from scratch. 61 case studies, regular people, real properties. Matt H. in Pittsburgh bought his first duplex at age 25 with an FHA 203 loan, putting 3.5% down and even financing renovation costs. Purchase price was around $180,000. He lived in one unit, rented the other. The rent covered most of my mortgage, if not all, he says. Essentially, he lived nearly free and built equity. 5 years later, that duplex appreciated, and Matt used the equity to buy a second property. Ashley, a single woman in Florida, saved $10,000 through disciplined budgeting and used a state first-time buyer program for additional down payment assistance. She bought a $200,000 condo with that $10,000 out of pocket. Her mortgage ended up slightly lower than her previous rent. Now, a few years later, the condo is worth $250,000. That $50,000 gain is hers, not a landlord's. John and Maria were newlyweds with little savings, but John was a veteran. They utilized a VA loan to buy a $300,000 house. They literally bought with no down payment, something available to many veterans. Their monthly housing costs stabilized, and they now have greater than $60,000 equity after 4 years simply from loan paydown and market appreciation. Another clever one. Devin, 30, teamed up with 2 friends to buy a triplex. They formed an LLC. Each contributed $5,000, which was 5% down on a $300,000 triplex in a Midwestern city. 61, 62, 63, they each took a unit. 2 live there, 1 unit rented out, the rents cover the mortgage, and they share building equity. It's a creative way to lighten the financial load and still get into property. And consider FHA house hack plus room rental. Brianna bought a 4-bedroom home with 5% down via FHA. She then rented out the other 3 rooms to roommates. Those rents not only cover the mortgage, she made a small profit each month and lived for free. She effectively turned her first home into a mini-income property. These stories show that you don't need generational wealth to own real estate. You need resourcefulness, knowledge of programs, and sometimes a willingness to live unconventionally. But the payoff is getting on the property ladder and letting tenants or time pay off the asset for you. Tools and resources programs to know. If you're a first-time buyer, research FHA loans. These allow credit scores 580 plus and 3.5% down. The trade-off is mortgage insurance premiums, but it gets you in the game. VA loans offer 0% down, no PMI, arguably the best loan out there. USDA loans provide 0% down for rural areas. Many cities, counties have down payment assistance grants or forgivable loans for first-timers. Income limits may apply, but definitely look them up. Some require a homebuyer class. Also, house hacking is a tool itself. By purchasing 2 to 4 units with an owner-occupied loan, you leverage low down payment to acquire rentals. Fun fact, FHA allows duplex, triplex, fourplex under residential loan. You just need to live in 1 unit. Lenders even count some of the future rent as income when you qualify, making it easier to get approved. 61, 64, 62, one more creative strategy. Seller financing. Sometimes a seller will let you pay them over time if they own the home free and clear, which can reduce how much cash you need up front. Or lease options. Lease a home with an option to buy later. Part of rent goes toward purchase. Can be viable if you need time to save or fix credit. But be cautious and get contracts checked. Mindset and preparation. Buying with little down doesn't mean no responsibility. Banks will still check your credit and debt to income, so work on credit score. Pay down small debts if possible to improve DTI. Also, be prepared to be landlord if you're renting out part of the property. That's a side hustle of sorts. Many have done it successfully, even while working full-time. It requires setting clear agreements with tenants. Educate yourself on fair housing laws, basic landlording. Plenty of resources online. Action steps, your path to property. Check your financial readiness. First, pull your credit report and credit score. If it's low, work on improving that over the next 6-12 months. Also, calculate your debt to income. Add up monthly debt payments divided by gross income. Lenders typically want DTI less than 43% for FHA. If it's higher, consider paying down some debt or increasing income before applying. Simultaneously, start saving specifically for home buying, not just down payment but closing costs and some cushion for repairs. Open a separate house fund savings account. Automate transfers into it. Even if you plan a low down payment, more savings helps you qualify and feel secure. Aim for at least a few. $65,000 save, more is better. Get pre-qualified and learn your market. Reach out to a mortgage lender or broker to get a pre-qualification or better, a pre-approval. This is free and doesn't obligate you. It will clarify the loan programs you can use, how much house price you could roughly afford given your income savings, and what monthly payment to expect. Knowing this prevents chasing homes outside your range. Ask the lender about first-time buyer programs in your area. They often know if local grants or assistance are available. Next, research the market you're interested in. Use sites like Zillow or Redfin to see prices of starter homes or multi-units. Note rents in the area too. Action. Within the next month, have an informational chat with a lender and possibly a real estate agent who works with first-time buyers. Don't be shy. You're gathering info, even if you're 12 months away from buying. This team can guide you on steps to take. That gives you concrete mini-goals. Consider house hacking. Crunch the numbers. If you're open to multi-unit or having roommates, analyze a potential deal. Example, find a duplex listing in your price range. Calculate the scenario. FHA 3.5% down. What's the mortgage, property tax, insurance, PMI? Then what rent could the other unit fetch? See how much of the mortgage the rent would cover. Many house hackers find that they can live for a fraction of what rent would be, or even profit slightly. E.g. Matt's duplex. Purchase $180,000, FHA down $6,300, mortgage $1,200 MO, rent from one side $900, covers 75% of mortgage. He lived for net $300 MO plus maintenance, way less than renting a place would have cost. If numbers are tight in your high-cost city, consider expanding search area or even rent where you live, own where it makes sense. But as a first-timer, owner-occupied deals usually get the best financing. So maybe target a less sexy neighborhood or small multifamily. Action. Do one full house hack analysis, even hypothetically. It will teach you how to evaluate real estate deals. Adjust variables like down payment or interest rate to see effect. This exercise demystifies the process and might reveal it's more attainable than you assumed. 63. Explore down payment hacks. If saving the down payment is the biggest hurdle, consider some creative tactics. First-time buyer grants. Check HUD's website or your state housing agency for programs. Some offer $5,000, $10,000 toward down payment if you fall under certain income thresholds. Gift money. If you have family willing to help with even a portion, most loans allow family gift funds. Retirement account loan, last resort, but some people borrow from their 401k for a down payment. Not ideal because you remove investments, but it can be an option if home ownership is urgent and the numbers make sense. House hacking itself is a hack because rental income you'll get can be considered by the lender to help you qualify. That means you can afford more house with multi-unit than a single family on the same salary. Also, budget hack. Once you're serious about buying, go into scrimp mode for 6-12 months. Pretend you already have a mortgage by setting aside the difference between that future mortgage and your current rent each month. This not only boosts your savings rapidly, it proves to yourself you can handle the payment. It's like a stress test. 61. Plan for ownership costs. Before you buy, prepare for the realities beyond the mortgage, maintenance, repairs, vacancies. A good rule is to save 1% of property value per year for maintenance. So on a $200,000 home, plan $2,000 a year to set aside for upkeep. Some years you use less, some more. Also, get landlord insurance if house hacking or renting. It's typically a bit more than homeowners insurance, but covers tenant-related liability. While looking, pay for a home inspection once you're in contract. It might uncover issues you can ask seller to fix or give you a heads up on future expenses. Mentally, shift to thinking like an owner. When an appliance breaks, it's on you. But don't let this scare you. Think of maintenance as protecting an asset that generally rises in value. Meanwhile, rents you collect often rise with inflation, but your fixed-rate mortgage stays the same, increasing your cash flow over time. Many find that after some years, their rental income exceeds their entire mortgage, turning their residence into a cash generator. Action. Make a mini homeownership budget now. Include mortgage, insurance, property tax, maintenance savings, and any HOA fees. Compare it to your current rent budget. This ensures your eyes are open to the true cost. If it's higher than you pay now, double-check you can handle it. If house hacking, also budget for some vacancy or tenant non-pay. Realistic timeline. The path to property can vary. Saving and prepping might take a year or more if you're starting from zero savings. For example, if you need $10,000 and can put away $500 MO, that's 20 months. But using assistance or cheaper properties can cut that requirement. Plenty of people have gone from idea to keys in hand within 6-12 months by laser focusing. If your credit is decent and you have steady income, the financing part can be approved in weeks. House hunting timeline depends on your market. In a competitive market, it might take a few offers over a few months to land one. In a buyer's market, you might find a deal in 1 month. Once under contract, typical closing is 30 to 60 days. So from accepted offer to moving in, expect 6-8 weeks. 66 if you start now with saving and pre-approval, you could feasibly be a homeowner by next year. But be patient if things take longer. It's better to do it right than rush into a bad deal. Remember, every year you wait can be a year of missed equity building. For instance, a $300,000 house that appreciates 3% adds $9,000 to your wealth in a year. And paying rent is 100% interest. So once you're reasonably ready, taking the plunge sooner is generally beneficial. If going multi-unit, anecdotally, some house hackers rinse and repeat, buy a duplex, live there a year, then buy another property and rent out both units of the first. FHA loans technically are for primary residences, but you can use them again if you move and the new purchase is your primary. Even with conventional, you can keep acquiring with lowish down. People have built significant portfolios in under a decade by leapfrogging like this. But for this chapter's scope, just focus on your first property. That's the big leap. So timeline summary. If you hustle, by this time next year, you might be collecting rent as a homeowner. If it takes 2-3 years due to saving or issues, that's okay too. You'll still likely be way ahead of where you'd be if you never tried. Within 5 years of owning, many see substantial net worth gains. And unlike stocks, you don't see the price changes daily, which is perhaps a blessing. You just steadily build wealth in the background. Real estate is often a get-rich-slowly, but significantly story. Starting without rich parents simply means you become the rich parent in the future by taking action now. 8. Same-day side hustles, fast cash on the side. Sometimes you need extra money now, not months from now. That's where same-day side hustles come in. These are gigs you can start almost immediately and potentially earn money within 24-48 hours. No long onboarding or special credentials needed, just your time and effort. The gig economy has exploded. By 2025, an estimated 39% of working Americans have some side hustle. Many of these can be started on a weekend or evening with minimal setup. Examples of near-instant side hustles: driving for Uber or Lyft, delivering for DoorDash or Instacart, freelancing small tasks on Fiverr, doing odd jobs via TaskRabbit, selling handcrafted items or printables on Etsy, tutoring or babysitting in your community, or even doing online microtask surveys. These hustles won't make you rich overnight, but they can generate an extra $50, $100, $200 in a pinch, which can be life-changing if you're trying to pay a bill or knock out debt faster. 45% of U.S. gig workers rely on side hustle income to cover basic costs, showing how mainstream it is to need that extra boost. The beauty of same-day hustles is the low barrier. Often you just need a smartphone, maybe a car or bike, and willingness to hustle. And the feedback is immediate. Work 3 hours tonight. See money in your app by tomorrow. This quick reward can motivate you to keep going or to funnel that money directly into your wealth goals. 2067 case studies, flipping debt into dollars. Lisa Ebsworth, a UK millennial, found herself with student loan and car debt. She turned to side gigs, starting with easy wins like surveys and secret shopping, and then ramping up to social media content creation. She made over £2,000 from surveys and £1,000 plus from TikTok's Creator Fund pretty quickly. Within a year, she paid off her loans and is now using side hustle income to aim for mortgage-free in 2 years. Her strategy was to try many simple hustles and stick with the lucrative ones. Ariel, in the U.S., had $30,000 of credit card debt and a low salary. She picked up any gig she could after work, driving Uber 3 nights a week, walking dogs via Rover on weekends, and flipping thrift store finds on eBay. She was making an extra $800 a month, which she threw entirely at her debt. In about 2.5 years, she killed the $30,000 balance. Devin is an actor whose gigs dried up in the pandemic. He pivoted to food delivery and warehouse gig work. Those side jobs kept him afloat and even helped him save a small emergency fund. Mike, a full-time teacher, started doing handyman tasks on TaskRabbit during summers. He could set availability freely and often got paid the same day for assembling furniture or fixing things. He earned about $5,000 one summer, which became the seed money for his first house down payment. Another example, Jen, a graphic designer, opened a Fiverr account offering quick logo design for $50 each. She got her first order within a day of posting. In her first month, she made $300, not huge, but immediate cash for a few hours' work, and it grew from there as she got reviews. These stories highlight that many side hustles can begin paying off literally today or tomorrow. The key is to sign up on that app, post that service offering, and to be willing to hustle in off hours. People have paid off significant debt, saved for goals, or simply survived tough times using immediate side gigs. 1668, 1669, 7070, 71 quick start gigs and tips. Rideshare delivery. If you have a car and a valid license, you can likely start driving for Uber, Lyft, or delivering food via Uber Eats, DoorDash within days. Background checks typically take a day or two, and then you're on. You get paid per ride or delivery, plus tips, often cashing out weekly or even instantly. Tip: focus on peak times to maximize earnings and track expenses for tax deductions. Online microtask surveys. Apps like Swagbucks, Survey Junkie, Amazon MTurk pay small amounts for surveys or simple tasks. Lisa found surveys easy but time-consuming. She wouldn't pay off debt with surveys alone, but they were good filler tasks at home at night. She made £2,000 from surveys by being consistent. For many, surveys might yield $50 to $100 a month in spare time. Not huge, but same-day accessible. Combine it with watching TV, and it's relatively painless free money. Just avoid any survey site that asks you to pay. Legit ones are free. 7273 Freelance Small Services. Market any skill on platforms. Writing, editing, graphic design, voiceovers, coding, video editing, you name it. Fiverr and Upwork have quick gig opportunities. Even if you feel, I'm not a pro, you can offer beginner-level services at a lower rate to start. E.g., if you can write blog posts, list a gig on Fiverr for 500-word article for $20. Many small businesses and individuals happily hire newcomers for a budget price. First gig might come in days or a week. And good news, Upwork just reported freelancers earned a median of $28 HR on the platform. While you may start lower, experienced freelancers on Upwork easily exceed traditional wages. Local odd jobs, the analog version of the gig economy. Put out the word or use Nextdoor Facebook that you'll do yard work, painting, cleaning, tech help, etc. A lot of people could use help and are willing to pay cash today. For example, offer to mow lawns in your neighborhood for $30 each. 5 lawns on a Saturday is $150. Or cleaning houses, many folks pay $100 plus for a deep clean. Get 2 done in a weekend and boom, $200. If you have handy skills, you might find a small repair job. Also, gig apps like TaskRabbit connect you to local tasks. TaskRabbit allows setting your hourly rate. As a newbie, set it modestly to get a couple jobs, then you can raise it as you get reviews. Payment is often just a day or two after task completion. Selling stuff. One quick side hustle you can do same day is selling unused items. Declutter your home and post items on Facebook Marketplace, OfferUp, Craigslist. You might have $500 worth of stuff gathering dust. Sell that bike you never ride, or those old electronics. Also flipping. Go to garage sales or thrift stores, find underpriced items, and list them online for profit. For instance, find a nice wood dresser for $20 at a yard sale, clean it up, sell for $100 online. It's quite doable in a short time frame. Some people even specialize. The great thing, selling items puts cash in hand and also frees your space. It's a 2-for-1 win. Behavior. Make it sustainable. Starting a side hustle is often exciting at first, but it can be tiring to maintain. Key tips. Set micro goals to keep motivation. For example, I'll do rideshare 3 nights a week until I earn $500 extra this month. Knowing the purpose helps push through when you'd rather relax. Also, avoid burnout. Same-day hustles can be physically and mentally taxing. Schedule in rest or limit the days you hustle so it's balanced with life. If you find one gig draining, perhaps rotate in an easier one. Variety can keep it fresh. Financially, treat side income wisely. Since it comes quickly, people sometimes also spend it quickly. Instead, route your gig earnings directly to your goal. If the app offers instant pay, you could instantly push that to your credit card payment, for example. Or set up a separate savings account for all side hustle deposits. Psychologically, seeing that account grow from $0 to $1,000 solely from your hustle can be very rewarding. One NerdWallet study found people who mentally separate side income are more likely to use it for productive goals, whereas if it just blends with checking, it might get frittered away. Finally, use same-day hustles as a gateway. Many times, what starts as a quick money fix can evolve into a bigger opportunity. Perhaps freelancing reveals you have a marketable skill that could become a full business. Or delivering might spark an idea for your own service. Stay open, but even if it remains a side gig, you'll have learned new skills. Action steps earn money this week. Sign up for one platform today. Don't procrastinate. Choose one gig platform that appeals and register right now. For instance, download DoorDash and complete the sign up tonight. Or create a profile on Fiverr or Upwork offering one service you can do. The sign up might take 30 minutes. Once approved, actively engage. If it's a marketplace, start bidding proposing on open gigs. If it's on demand, mark your calendar for when you'll do your first shifts. Taking that first step, account created and first gig scheduled, is huge. Leverage your immediate network. While waiting for app approvals or as another avenue, put a message out to friends, family, or on social media. E.g., I'm available for, let me know if you or anyone needs help. You might snag a side job from someone you know. Many people trust hiring someone they know for small jobs. Perhaps Aunt Mary needs help organizing her garage and would pay you $100 for a day's work. Or a neighbor needs babysitting. Don't be shy. Lots of folks could use a hand, and you'll earn plus strengthen community ties. Set a 30-day side hustle challenge. Motivate yourself with a short-term challenge. E.g., over the next 30 days, I will earn $X from side hustles. Make X a stretch but achievable amount. Break it down by week. Track your progress visually. This challenge adds gamification. You can also follow along with online communities doing similar challenges. Publicly committing, or even just putting it on paper, ups your accountability. At the end of 30 days, evaluate. Did some gigs pay way better than others? Which did you enjoy or hate? Then double down on the effective gigs for the next 30 days. Use idle time efficiently. Identify pockets of time in your schedule that could be turned into money. For example, if you normally watch Netflix 2 hours a night, maybe dedicate one of those to a side gig. If you have a long commute, perhaps you can do a gig during it. Weekends are prime time. Maybe decide every Saturday morning 9 a.m. to 12 p.m. is hustle time. Treat it like an appointment. Additionally, stack gigs if possible. E.g., if driving for Uber Eats and it's slow, have a survey app going while waiting. If doing laundry or something at home, fill out surveys on your phone simultaneously. These little efficiencies can add a few extra bucks with minimal extra effort. Direct side income to goals immediately. As mentioned, have a plan for the money so it doesn't evaporate. Ideally, automate it. If you get paid via PayPal or bank deposit, set up an automatic transfer to your credit card or savings account of those amounts. Or each time you get paid from a gig, manually transfer it the same day to the intended destination. For example, Lisa put her side hustle earnings straight into paying off her student loan and card debt. If your goal is wealth building, perhaps every $100 you earn side hustling, you immediately invest $50 of it. That way you're both improving present finances and building future wealth. Same-day hustles can become same-day investments. Imagine that, delivering pizza tonight. 16, and tomorrow that money is buying shares of an index fund for your future. That's the hustler-to-investor pipeline you want to create. Realistic timeline. The beauty here is the timeline is immediate. You could sign up for an app today and literally have extra cash in hand tomorrow or this week. For instance, many delivery drivers report making $100, $200 their first weekend out. Surveys or microtasks might make only $5, $10 day, but if you do it daily, that's $300 in 2 months, which could be an extra car payment. The key is consistency. Doing a gig one weekend, then stopping won't move the needle much. But doing it weekly over a few months can achieve notable financial goals. In 1 month of active side hustling, you could realistically earn a few hundred to $1,000 plus, depending on the hustle and hours. Over a year, even a modest $200 month side gig is $2,400, which could pay off a credit card or seed an emergency fund. Many find that once they start, they discover ways to increase earnings. For example, a side freelance writer might make $100 the first month, $300 the second as they get more gigs, and be up to $1,000 a month by month 6 after building reputation. So income can ramp up over time. Also, the timeline for achieving your purpose shortens. If you planned it would take 3 years to clear debt with just your day job, adding hustles might cut it to 1 year. Lisa paying off her student and car loans in a year thanks to side hustles is a testament. Remember to evaluate periodically. Same-day hustles are often stepping stones. After 6-12 months, you might transition to more advanced side hustles or even start a small business using skills you picked up. Or you might dial back once you hit a goal. That's fine. Side hustles are flexible. You can ramp up when you need cash or a push toward a goal, and pause or reduce when life gets busy or you need a break. The important thing is knowing that you have this lever you can pull to generate money outside your main job. That knowledge alone is empowering and puts you more in control of your financial destiny. 9. From hustle to business scaling up, the entrepreneurial leap. A side hustle can be more than extra cash. It can be the seed of your own business. Many big companies started as tiny hustles in a garage or spare room. The difference between a hustle and a business often lies in scalability and systems. When you turn your one-person gig into a business, you move from just creating a job for yourself to building an enterprise that can grow beyond just you. This often means formalizing, branding, and marketing your services to a wider audience and potentially hiring or outsourcing to expand capacity. The transition is mindset too. You start thinking like a business owner, focusing on processes, customer experience, and strategy, not just doing the work. If your side hustle has consistent demand and you find yourself with more work than time, it's a signal you can scale. In 2025, entrepreneurship is more accessible than ever. You have online marketplaces, social media to reach clients, low-cost e-commerce, and a gig economy workforce to tap. Surveys show a strong trend. About 50% of millennials with side hustles hope to turn them into full-time businesses. And increasingly, people are succeeding. The U.S. saw a record 5+ million new business applications in 2021. Even if your goal isn't a billion-dollar startup, a small business can mean being your own boss and achieving financial freedom on your terms. 24-26-19. Case studies, hustlers to CEOs. Crystal Luray turned her creative side hustle into a 6-figure monthly business. She started by painting custom needlepoint canvases as a hobby and selling a few on Instagram. Demand blew up. She launched Penny Lynn Designs online, spending about $7,000 on initial inventory and website. By 2024, at age 34, her new age needlepoint store hit $4.4 million in revenue. She essentially created a whole brand from a craft hustle and now employs help to scale. Dennis Tenorino transformed a $36 domain flipping side gig into a steady 6-figure business. He started in 2014, flipping a few website domain names. As profits grew, he formalized into Domain Smoke. He spends 1-2 hours a day on this now, making over $100,000 a year, truly a lifestyle business. Sarah and Emily, two best friends, began a side hustle making gym scrunchies because they saw a need at workouts. They invested a few hundred in fabric and sewing. The product took off locally, so they opened an online store. Within 2 years, their Sweat Scrunch brand was making $10 million in annual revenue. They had to outsource manufacturing and build a team to meet demand. Not all stories are that explosive, but even modest scale is impactful. Marissa C. had $40,000 debt and did various side hustles to pay it off. She realized coaching was her passion. She went full-time, branded her financial coaching business Kaz Coaching, and now not only is debt-free, but has a thriving practice helping others. Or Janelle, who drove Uber to fund her baking hobby, then started selling custom cakes. After consistent orders, she formalized into Janelle's Bakery, rented a commercial kitchen space, and now caters events regularly. Her hustle became a business, making triple what Uber did. These narratives show critical points. They recognized demand and decided to go bigger. They invested into branding scale, and often they leveraged digital platforms for wider reach. The leap of faith, quitting the day job or dedicating full focus, often came once the side business income either rivaled their job or the opportunity was clearly large. The payoff, autonomy, and uncapped growth. 74, 75, 76, 77, 78, 77, 79, 80, 81 key steps to turn hustle into biz. Formalize and protect. Register a business entity. Get any required licenses. Open a business bank account. This separates your finances. It also signals mentally this is a real business now. Many find an LLC worth it for credibility when dealing with clients. Also consider trademarks if you have a brand name, and definitely secure domain names handles for your business online. All this can often be done in a matter of weeks. Brand and market. Develop a brand identity, business name, a simple logo, and consistent visuals. Set up a website or professional profile. It need not be fancy. A one-page site describing your services and contact info is fine to start. Importantly, collect testimonials from your hustle clients to showcase. As a business, you'll need to market beyond word of mouth. Use the appropriate channels, e.g. if you're B2B, create a LinkedIn page and start posting valuable content. If B2C, use Instagram, TikTok, etc. Leverage free marketing. Request reviews on Google or Yelp if it's local. If budget allows, consider small targeted ads. The goal is to reach more people than you could as just a random gig worker. Establishing an online presence can significantly broaden your clientele, e.g., Krista's Penny Lynn took off once she put her collection online for nationwide customers. 82 Scale operations. Identify how you can take on more volume without burning out. This might mean delegating or automating parts of the work. Can you outsource some tasks to contractors' employees? For instance, if your hustle was graphic design, maybe you contract junior designers for draft work while you handle client relations and final touches. Thus, you can serve more clients. If your hustle was making crafts, perhaps outsource production to a manufacturer once orders exceed your capacity, while you focus on design and sales. Embrace tools, scheduling software, accounting software, customer management tools, etc. Process is key. Document how you do things so that someone else can replicate it. Even if you're not hiring yet, write SOPs for major tasks. This makes onboarding help much easier when time comes. 8283 Mindset Shift, CEO Time. As a business owner, allocate time not only in the business but on the business. This might mean once a week you step back and analyze what services products are most profitable. Where are bottlenecks? How can I get more customers or reduce costs? Essentially, wear the CEO hat. Many new owners struggle here because they're used to just hustling for money. But stepping back can reveal growth opportunities or efficiencies. Example, Dennis the domain flipper realized he could start a daily newsletter of domains for sale that scaled his sales beyond one-on-one deals, effectively making a marketplace where multiple buyers bid. He wouldn't have done that if he hadn't thought about strategy versus just flipping one domain at a time. Another tip, surround yourself with support. Join a local business network or online group of entrepreneurs for advice and mentorship. Suddenly going from solo hustle to business can be overwhelming. Learning from others who did it is invaluable. Financials and legality. Crunch numbers to ensure the business can sustain you. Ideally, when transitioning, have at least 3 to 6 months of expenses saved as buffer. Also, project your income potential. If your hustle made $1,000 a month in 10 hours a week, full-time 40 hours could theoretically be $4,000 a month. But consider extra time for admin marketing. You might not bill 40 hours. Still, if projections show you can surpass your job income, or it's trending upward month over month, that's a positive sign. On legal side, as mentioned, get the structure and any necessary insurance. And taxes. As a business, track all expenses. Many are deductible. Consider consulting a CPA to optimize for business taxes, or when to maybe switch from LLC to S-Corp for tax advantages. Action steps. Going from side gig to legit biz. Write a simple business plan. Doesn't need to be formal 50-page doc. Just a 1 to 2 pager covering. What problem do you solve or need do you meet? Who are your target customers? How will you reach them? What are your revenue streams and pricing? What are your costs? And what are your goals? This clarity will guide your actions. Writing it forces you to think about aspects you might overlook. Many free templates exist for lean business plans. Do this before quitting any main job, so you have a roadmap. Register the business and separate finances. Decide on a business name. Register your LLC or DBA with the state county. Get an EIN from the IRS free and use to open bank accounts and for tax IDs. Open a business checking account and possibly a business credit card. Transfer any equipment or costs you regularly use for the hustle to be paid from the biz account. This step may seem paperwork-y, but you can do it in a week or 2. It officially kicks off your identity as a business owner. Also, create any essential legal docs, client contract templates, invoices with your branding, etc. Many freelancers turn business skip the legal formalities. Don't. A solid contract that outlines scope, payment terms, and what happens in disputes will save headaches and make you look professional. Gradually transition your time focus. You don't necessarily jump from 10 hours a week to 60 overnight. Consider a phased approach, e.g., go part-time at your day job if possible as your biz picks up, or use evenings, weekends to start scaling systems before you quit. When you do go full-time, accept that early on you might still be doing everything until revenue supports hiring help. It's okay to hustle within your business at first, but set target triggers for when to outsource or hire. For instance, when revenue hits $X or I'm consistently working 60+ hours, I will hire a part-time assistant or subcontractor. That way you don't burn out as the business scales. Market. As a business owner, especially at the start, allocate significant time to getting customers. A rule of thumb, perhaps 50% of your efforts initially should be marketing sales. It's uncomfortable for some, but necessary. That might mean cold emailing prospective clients, asking for referrals explicitly, running small ad campaigns, or pumping out content to attract interest. For example, a graphic design freelancer turned agency might start a blog or Insta showcasing design tips and portfolio pieces to draw in leads. A local service might hustle by attending networking events or partnering with related businesses. One effective tactic, leverage your existing happy customers. Ask them for testimonials. Ask for referrals. Do you know anyone else who could use my services? I'd love an intro. People often are glad to help if you ask. As you grow, word of mouth can become your strongest channel, but you have to kickstart that flywheel. Refine and expand offerings, evaluate what's working best, and consider expanding or niching down accordingly. Sometimes focusing on a niche can accelerate growth because you become known for that specialty. E.g., instead of a generic virtual assistant service, maybe your business becomes VA for real estate professionals, a niche where you tailor exactly to those clients' needs, and thus can charge premium and get referrals in that community. Or in contrast, if one side product took off, add complementary products. For instance, Krista started with canvases, then added accessories to increase average order value. Think about how to get more revenue per customer. A consultant might create an online course to sell, turning one-on-one service into one-to-many product, a scaling move. At the same time, keep an eye on quality and customer service as you expand. That's your reputation. Build systems to maintain quality. 82 realistic timeline. Growing from a one-person hustle to stable small business typically takes 1 to 3 years. Year 1 is often about foundation and replacing your previous income. Year 2 might be growth and hiring first help. By year 3, many see solid profits and a more systematized operation. For instance, Krista's timeline. Hobby in 2019, launched business 2020, by 2024 multi-million revenue. That's fast, aided by social media virality. Not every story is that quick, but even a moderate path. Say your side hustle made $1,000 MO. In business year 1, you push it to $3,000 MO average. Year 2, you hit $6,000 MO. Year 3, you're at $10,000 MO. That progression is achievable if you're in a good market and reinvest profits into growth. 76. However, be prepared for uncertainty. Business income can be uneven. You might have feast and famine cycles early on. That's why that emergency fund and keeping expenses lean helps you weather it. Over time, as you build a client base or recurring revenue, cash flow evens out. Aim to transition from one-off gigs to more recurring revenue. This gives stability and predictability. One realistic challenge, burnout risk. Those first couple years you might work more than you ever did at a job, but remember, you're building an asset for yourself. The goal is by year 3 to 5, you can start stepping back a bit and letting the business work for you. It's not an overnight journey, but the freedom and potential upside are tremendous. Also, timeline note, if your business requires funding to scale, you might spend time seeking loans or investors. Many small businesses are funded by revenues and perhaps a small bank loan or SBA microloan. Traditional financing often looks for 2 years of business history, but there are startup-friendly options. Build those into timeline if needed. In summary, turning a hustle into a business is a marathon of sprints. You'll go through intense phases, but if you pace well, within a few years you could go from side earner to a full-fledged entrepreneur with an asset that has its own momentum. As the boss, your income is uncapped. The business's profits can keep growing as you scale, which is a different game from trading time for money. The transformation can be life-changing. You're no longer just making ends meet, you're creating jobs and generating wealth. It all starts with that decision to treat your hustle seriously and aim higher. Today, you the hustler. Tomorrow, you the CEO. 10. The $500 Wealth Blueprint. Small money, big moves. You might think $500 isn't much in the world of wealth building, but even a few $100s, if used smartly, can be a catalyst. This chapter is about maximizing a small starting sum to create outsized impact. Whether it's $500 save a $500 windfall, or the first $500 you free up from budgeting or hustling, the idea is to deploy it strategically for high return on investment. Remember, many wealth journeys began with a few $100. For example, investor Charles Schwab started his brokerage with a few $100s in the 1970s. In practical terms, think of $500 as seed capital. You can invest it, use it to eliminate costly debt, or invest in yourself for higher income. If you handle $500 right, it can turn into $5,000 over time, then $50,000. The snowball starts rolling. Unfortunately, a lot of small sums get blown on impulse buys. But every dollar is a seed. Given time or skill, it grows. A survey by Capital Group found a majority of Americans felt $500 was too little to invest, which is a myth. In reality, just $500 invested in an S&P 500 index in 1980 would be about $17,000 today. And if you add to it consistently, the effect multiplies. The blueprint here will combine concepts from previous chapters into a concrete plan for that first $500. Some should go to secure your foundation, some to crush high-interest debt if you have it, some to invest for compounding, and possibly some to skill building or side hustle to multiply itself. It's like building a wealth machine with $500 as the starter engine. 13 case studies, transforming $500. Tasha had exactly $500 saved when she decided to start investing. She opened a Roth IRA and bought an S&P 500 index fund with it. That small start gave her the confidence to keep contributing. A decade later, she has $50,000 in that IRA, which she credits to just getting going with $500. Marcus took $500 to launch a micro-business. He noticed a lack of affordable lawn care in his area. He bought a used lawnmower for $150, a leaf blower for $100, printed $50 of flyers, and reserved $200 for gas and maintenance. Within the first summer, he had 10 regular yards, earning $2,000. He reinvested profits to upgrade equipment. 3 years later, he runs a landscaping side business grossing $30,000 a year, all from that initial $500 gear investment. Alicia, burdened with credit card debt at 24% APR, used $500 from a bonus to pay a chunk of it. That $500 immediately saved her about $120 in annual interest. Plus, it boosted her credit utilization ratio, nudging her credit score up, which later qualified her for a lower-rate refinance on the remaining debt. So that $500 probably saved her hundreds more in interest long-term. Dev allocated his first $500 across a few buckets: $200 to start an emergency fund, $200 toward his highest interest student loan, and $100 into buying a course on programming. The course helped him land a better job within a year, boosting his salary by 20%. That $100 for learning paid back exponentially. Janine used $500 to get a real estate license course. With that license, she started part-time real estate agent work and earned her first $5,000 commission 6 months later. Key point: each of these used $500 as leverage to cut expenses, increase earnings, or compound. Even smaller moves show effect, e.g. putting $500 of extra principal into your 30-year mortgage in year one can save you maybe $1,000 in interest and cut a few months off term. The numbers seem small, but repeated or combined with other tactics, they accelerate your journey. Blueprint: where to allocate. If you have high-interest debt, knocking that down is priority. Paying off debt is a guaranteed return equivalent to the interest rate. So a chunk of the $500 should likely go there if applicable. Next, ensure you have some emergency cushion. Even $200 in a rainy day fund prevents you from going deeper into debt for a minor emergency. After that, investing some is key to get the compounding started. If you haven't opened an investment account yet, $500 is plenty to do so. Many brokerages have $0 minimums now. Also, consider self-investment. If a certificate or tool can significantly boost income, it may yield more than a stock market investment. For instance, $500 toward a tech certification that gets you a $5,000 raise is an incredible ROI. Or $500 to buy a quality secondhand camera to start a photography side gig that later brings $500 per client. It's about ROI-minded thinking. 28 actionable steps. The $500 plan. Let's outline a concrete plan for someone with around $500 and wanting to maximize it. High interest debt. If yes, allocate 50% of your $500 here first. For example, Put $250 toward your credit card balance. This immediately saves future interest and speeds debt payoff. Emergency Fund Seed. Take $100 of the $500 and park it in a safe savings account. Now you've got a starter buffer for small surprises. Plan to keep adding $20 a month to this from your budget hustle until it hits maybe $1,000, then larger goals. Invest in assets. Use $100 to $150 to start investing. Options. Open that Roth IRA or brokerage account and buy a broad index fund or ETF. Or, if you prefer, put it into a micro-investing app that automates it. Yes, $100 in the market won't turn into 1, 2, 3 millions overnight, but it breaks the ice, and every journey starts with a first investment. Historically, every $1 invested in S&P 500 doubles roughly every 10 years. So think of that $100 potentially being $200 in 10 years, for $100 in 20, etc. And you'll add more along the way, accelerating that. 13. Skill income investment. Use the remaining $100 on something that will help you earn more. That could be buying a tool or software subscription for your side hustle, or a course on a platform like Udemy, Coursera to learn a high-income skill. This is crucial because boosting your income is a major wealth multiplier. For instance, if that $100 course helps you negotiate a $5,000 salary increase or start side gig earning $200 a month, the ROI is enormous. Naval Ravikant says, investing in yourself has the best return. For 84 Entrepreneurial Microfund, if you have a business idea swirling, allocate a part of the $500 to test it. Maybe $50 for running a small Facebook ad to see if people click your product idea, or buy initial inventory to validate sales. For example, one person took $36 to start domain flipping and turned it into 6 figures. Small experiments can lead to big outcomes. With $500, you could start a simple dropshipping store or an Etsy print-on-demand shop fairly easily and see if it gains traction. Treat it like seed capital. Be willing to lose this small piece in exchange for knowledge of what works. 5. 85-86. By diversifying the $500 into these areas, you cover offense and defense. Offense by investing in earning assets and skills. Defense by reducing debt and shoring up emergency funds. It's essentially a mini wealth ecosystem. Timeline and next steps. Execute these moves within a month. All can be done quickly. In Week 1, make the extra debt payment and open the savings and investment accounts. Week 2, purchase your course or tool and schedule time to use it. If exploring a micro business, list a couple items for sale or spend a weekend building a simple site. Test the waters. In 3 months, check progress. Has your debt decreased? Is your emergency fund grown? What's your investment worth? Have you completed the skill course? If so, update your resume or freelance profile and start reaping that benefit. Possibly by 3 to 6 months, you might already see a raise or side income thanks to that skill tool investment. Also, reinvest new surpluses. Maybe the $250 debt pay freed up $15 of monthly interest that you no longer pay. Redirect that $15 to investments or savings each month going forward. Psychologically, deploying $500 wisely gives you momentum. Many feel stuck when they only have a few hundred. They think, what's the point? But when you see it actually improving your finances tangibly, it reinforces positive habits. It's crucial at this stage to avoid the temptation to splurge that $500 on fleeting consumption. By flipping $500 into wealth-building uses, you essentially plant seeds that will yield continuous benefits instead of a one-time satisfaction. To keep the blueprint going, now challenge yourself. Can you find the next $500 to repeat the process? Perhaps through side hustles or tightening budget, or when you get a bonus tax refund. Each $500 chunk can be deployed similarly. Kill some debt, boost investments, invest in self. Over a couple years, those chunks will drastically change your net worth trajectory. In summary, don't underestimate small capital. Use the $500 blueprint as often as possible, and it won't be long before those small wins accumulate into serious wealth. 11. 30-day financial bootcamp. Jumpstart your finances in 1 month. Sometimes the hardest part of transforming your money life is just getting started and building momentum. That's where a 30-day financial bootcamp comes in, a focused 1-month challenge where each day you take a specific action to dramatically improve your finances. It's like a crash diet for your wallet. Research shows that 30 days is enough time to form new habits or at least see significant change. It's shorter than the 66 days average for full habit automation, but it's a manageable burst that can reset your behavior. Think of it as a personal finance sprint. In 1 month, you attack wasteful spending, set up systems, and implement hacks that you might otherwise put off for years. Many people who do these challenges report feeling significantly more in control and often save hundreds of dollars in that single month through renegotiating bills, cutting unnecessary costs, selling things, etc. For example, one popular 30-day money challenge had participants save $500 in a month by doing daily tasks. By condensing the work into a short timeline, you overcome procrastination and see quick wins that motivate you to continue. 428788 case studies, 1 month to win. Tiffany was living paycheck to paycheck and decided to do a self-imposed 30-day no-spend challenge. For an entire month, she only spent on absolute essentials, no restaurants, no shopping, no paid entertainment. She got creative cooking at home and finding free activities. In that month, she saved $600, which had never happened before. More importantly, she learned she could live happily with far fewer impulse purchases, which permanently reduced her spending thereafter. Jake and Melissa, a couple, did a financial detox month. They had 30 tasks based on a blog challenge. Day 1, they tracked every expense. Day 2, they switched to a cheaper cell plan, saving $50 a month. Day 5, they refinanced auto insurance, saving $300 a year. Day 10, they set up auto transfer to savings, etc. At the end of 30 days, they had paid off a lingering $1,000 credit card and built a $1,000 emergency fund. They said the structured daily to-dos made it almost fun, like a financial scavenger hunt. NerdWallet has a series, How I Ditched Debt, and one person profiled said the breakthrough was a 1-month challenge where she only paid with cash and tracked everything. In that month, she realized her true priorities and cut $500 of fluff, which she then consistently redirected to debt payoff, becoming debt-free in a year. A financial advisor, Tim, sometimes puts clients on a 21-day cash diet. For 3 weeks, only use cash envelopes for variable spending. He reported clients often end the period with a few hundred left over that they normally would have unknowingly frittered on cards. It's short enough that they stick to it and long enough to instill mindfulness in spending. Another example, Marie did a 4-week Increase Your Income challenge. Each week, she tried a new side hustle for just that week. In 1 month, she made an extra $800 and discovered she actually liked selling online the most, which she continued as a regular side business. The point is, a bootcamp approach can yield surprising results in a short span because of intense focus and daily accountability. 882838 Psychology. Why 30 days works. A month is a short enough horizon to prevent burnout or I'll do it later mentality. You can do almost anything for 30 days. It also leverages consistency and commitment bias. Once you publicly or privately commit to a 30-day challenge, you're more likely to follow through daily because it's finite and structured. There's also a sense of competition gamification if you're following a set challenge or doing it with a friend. Each completed task gives a small dopamine hit. This positive reinforcement builds the habit loop. By day 30, you've practiced these behaviors enough that continuing them isn't as hard going forward. Another effect, success breeds self-efficacy. When you see what you can achieve in a month, you start believing, I am capable of managing my finances, which can permanently shift your identity around money. Boot camps often also introduce an element of social support or pressure. Many challenges are done in groups or shared on social media. This taps into accountability and normative behavior. If others are doing it, you feel motivated to keep up. 46 Cognitively, it breaks big intimidating goals into one-a-day micro-actions. Also, by front-loading many money improvements into 1 month, you eliminate a lot of future decision fatigue. For example, in 30 days you might automate and simplify so many things that later you're not constantly deciding whether to save or pay this or that. It's all set, habit formed. Essentially, you use a blast of willpower for 30 days to put your finances on autopilot thereafter. Action steps, your 30-day plan. Here's a recommended outline for a 30-day financial bootcamp with daily actions. Week 1, awareness and quick wins. Day 1, track every penny spent, start spending log, and log all expenses this month. Awareness is the foundation. Day 2, make a budget, list out your income, then your necessary expenses, then discretionary. Identify the gap you can save or use to pay debt. Use the 50-30-20 guideline or whatever fits. This is your roadmap for the month. 90-91 Day 3. Cut one bill. Look at subscriptions memberships. Cancel at least one service you barely use. Savings may be $10 to $50 a month going forward. Day 4. Negotiate a bill. pick a recurring bill. Call and ask for a better rate or any promotions. Many companies will lower your rate if you politely threaten cancellation or mention competitors. You might shave $10 to $30 off, which over a year is real money. Day 5. No spend day. Don't spend a single dollar today. Eat at home, use what you have. This flexes your discipline muscle and shows you can have a fun day without spending. Do at least one no-spend day each week of the month. 88 Day 6. Automate a transfer. Set up an automatic transfer from checking to savings or investment each payday. Also, if you haven't already, set your bills on autopay to avoid late fees. Today's the day to log into bank and do these setups. 33 Day 7. Meal plan for week. Food is a huge budget leak for many. Plan your meals for the upcoming week and grocery shop with a list. This prevents impulse buys and takeout overspending. Many find they save $50 plus per week doing this. Week 2. Debt and income focus. Day 8. Check your credit report and score. Get free credit report and see where you stand. Correct any errors if found. Knowing your score is important. If score is low, identify why and plan fixes. Day 9. Make an extra debt payment. Put any money freed from week 1's cuts directly towards your highest interest debt. Even if just $50 extra to credit card, do it now. Day 10. Refinance or consolidate. Research if you can get a better interest rate on any debt. Maybe a 0% balance transfer offer for your credit card or refinancing student loans or your car. If viable, start the process. If you have multiple cards, consider calling card company to request an interest rate reduction. Sometimes they oblige if you have good history. Day 11. Declutter and sell. Identify at least 5 items in your home you don't need that could be sold. Take photos and list them on Facebook Marketplace, eBay, etc. This not only brings in a bit of cash this month, but declutters your space. 92 Day 12. Increase income day. Side hustle push. If you've thought about a side hustle, spend a day setting it up. Create that Fiverr profile, sign up for Uber or TaskRabbit, or even just ask around for odd jobs. Alternatively, if overtime at work is possible, volunteer for an extra shift. The goal, by end of the month, earn something extra. Even $50 from a gig is a win. Today's the setup day. Day 13. Ask for a discount. For any purchase you have to make, or even at a local market, try asking, is there any discount available? Or using a coupon. This builds habit of never paying full price unnecessarily. You might save 10 to 20% just by asking. Day 14. Financial education burst. Read an article or chapter of a personal finance book today. The goal is to invest 30 minutes learning. Building knowledge will pay off beyond this month, and a boot camp should include some education. Week 3. Long-term moves and optimization. Day 15. Open an investment account. If you haven't started investing, do it today. Open a brokerage or Roth IRA at a low-cost provider. It may take 15 minutes online. Set up a small automatic contribution. Bootcamp is about pushing through inertia. This is a big push that future you will thank you for. If you already invest, today review your portfolio allocation to ensure it aligns with your goals. Day 16. Insurance checkup. Review your insurance policies. Do you have adequate life insurance? If not, note to get quotes for term life. Also check deductibles. Maybe you can raise auto-home deductibles slightly to reduce premiums. See if bundling home auto saves money. This is about risk management, often overlooked but critical for financial stability. 93 Day 17. Update will and beneficiaries. Not fun, but important. If you have any assets or kids, a simple will is key. You can use online templates or free clinics. At least ensure all your account beneficiaries are set and up to date. This one-day task will protect your loved ones and is part of holistic financial health. Day 18. Mid-month review. Look at your spending log and budget performance so far. How are you doing? Identify any problem categories where you're slipping. Adjust the plan for remaining days if needed. Also tally any extra money saved earned so far. If behind on goals, refocus. Day 19. Cut one luxury and replace with free alternative, e.g., skip the pricey latte and make coffee at home, skip movie theater and watch something on your existing subscription. The idea is to realize you can enjoy life at lower costs sometimes. Not saying cut forever, just flexing frugality muscles. Day 20. Set a big goal. Think of a major financial goal. Break it into a monthly or per paycheck target. Then, if possible, automate contributions toward it. For example, Big goal $5,000 YEF in year equals about $417 MO. Maybe you can auto-transfer $200 MO now and plan to increase with future raises hustles. The key is having a concrete goal, an initial plan. Write it down and perhaps put a visual progress chart on your wall fridge. Research shows making goals specific and trackable makes you far more likely to achieve them. 94-95 Week 4. Finish strong and future-proof. Day 21. No technology day. This might sound odd for finances, but take a day without browsing shopping sites, seeing ads, or influenced by social media hauls. Often our spending is prompted by digital temptations. A detox day can break urge cycles and also is free fun. You'll spend $0 and maybe realize you don't miss much. Day 22. Explore a library or free resource. Visit your local library. Get a library card, if not. Libraries offer free entertainment, which can replace paid alternatives. Maybe you find a personal finance book there for continued learning. This day is about reinforcing using free community resources versus paid services. Day 23. Cook something new. Challenge yourself to make a meal from stuff you already have in pantry freezer. Many households waste food or have unused staples. Use them up creatively. This saves money on groceries and prevents waste. Day 24. Plan next month's budget early. As you near end of boot camp, draw up your budget for the next month now. Incorporate what you learned. Adjust categories to realistic levels. Include the new savings investment transfers you set up. Remove costs you eliminated. Doing it early ensures you don't lose momentum. Once this challenge ends, you roll right into a new month with a solid plan. Day 25. Celebrate small wins. By now, you've likely had successes, paid off something, hit a savings target, etc. It's important to reward yourself to keep morale. But do it frugally, e.g. have a DIY spa night at home or a potluck with friends to celebrate the final stretch. Recognize your hard work. You deserve a pat on the back that doesn't break the bank. Day 26. Find a financial buddy or mentor. Long-term, having someone to discuss money with helps accountability. Reach out to a friend or join an online group. Share that you did this 30-day bootcamp and perhaps invite others to try it. If you have access to a financial advisor through work or community, perhaps set a meeting. Essentially, set up post-bootcamp support. Day 27. Revisit insurance and beneficiaries. Ensure any changes needed are underway. E.g., if you decided to get life insurance, have you gotten quotes or scheduled application? Do that now. Double-check you updated beneficiaries on all accounts. Boring but necessary details, finish them. Day 28. Reflect on habit changes. Think about which daily tasks were hardest and which were easiest. Plan how to integrate the beneficial ones into regular routine. For instance, maybe you discovered you actually like cooking and it saves you $X. Commit to meal planning weekly going forward. Or if tracking expenses helped, decide on a tool to keep doing it. Write down 2 to 3 new habits you'll maintain. Day 29. Finalize gains. If you earned extra income this month, make sure it's put to use, not just sitting to be spent. Ideally, funnel it to your goal. E.g., you made $400, use $300 to pay debt now, and $100 to savings. If you manage to underspend your budget by $200, formally transfer that to your emergency fund or investment rather than letting it roll over to possibly get spent. Basically, lock in the progress. Day 30. Bootcamp graduation and next steps. Review the entire month. Tally total debt paid, total saved, etc. Compare to day 1. Feel proud of progress. Write a short money mission statement for yourself moving forward, e.g., I am in control of my money. I will continue to budget, live below my means, and build wealth for my family's future. This helps cement your new identity as someone who is financially disciplined. Finally, plan a modest celebration or reward for completing the bootcamp. Tell yourself this isn't the end, it's the springboard. Mark your calendar 1 month from now for a check-in to ensure you're keeping up the good habits. Realistic outcome. In 30 days of bootcamp, you could realistically achieve hundreds of dollars of immediate savings, elimination or reduction of pesky bills, a workable budget, automated finances, perhaps plus 50 to plus 100-point credit score improvement, a starter emergency fund, first investments made, and a clear plan to tackle debt and goals. Just as important, you'll likely feel empowered and no longer avoidant about money. 1 month of intense focus can fundamentally alter your financial trajectory, and many outcomes will be ongoing. The key is sustaining the good practices you started. Not every day's habit will stick, but many will. People often say after a 30-day challenge, The second month is night and day different from before. Money isn't a mystery or enemy anymore. It's something they actively manage. That confidence boost is priceless. Even if you slip a bit after, you now have a toolkit to course correct. You could even repeat a mini boot camp every 6 or 12 months to reinforce habits. But the hope is that by end of this boot camp, you've built momentum that carries on. 30 days can change your money life. Take the challenge, and by this time next month, you'll be amazed at the transformation. 12. The Freedom Blueprint, designing your life of financial freedom. We've covered specific tactics and areas. Now it's time to put all together into your personal freedom blueprint. What is financial freedom? It's the point where money is no longer a constant source of stress, and you have choices. Maybe it's complete fire with enough investments to live off. Or maybe it's simply being debt-free with a comfy emergency fund and the ability to work on your own terms. The exact vision is personal, but the common theme is money enables your life rather than constrains it. Achieving this requires integrating everything we've discussed: mindset shifts, higher income through skills business, disciplined saving, investing, and strategic use of assets like real estate and stocks to generate passive income. A key aspect of the Freedom Blueprint is that it's not a get-rich-quick scheme. It's a long-term life plan. It often involves multiple stages. Many who reach financial independence do so after, say, 10, 15 years of focused effort. But even if your goal isn't to retire super early, the blueprint aims to give you freedom of time and choice, maybe decades earlier than traditional retirement. Case studies: Paths to Freedom. Mr. Money Mustache is a famous FIRE case. He and his wife both worked in tech, earning middle-class incomes, saved 50 to 70% of their income by living simply, and retired at age 30 with around $600,000 invested that produces enough investment income to live on. They then have lived free for many years, doing projects they want. Their blueprint was extreme frugality plus index investing. Ramit Sethi often shares stories of people who designed their rich life in different ways. One couple became location independent by building an online business and moving to a low-cost country, not retired, but free to travel and work on their terms with comfortable passive income from e-commerce. Another individual achieved freedom by building up a rental property portfolio of 10 homes over 15 years. Now the rental income exceeds his expenses, so at 50 he quit corporate life to manage properties a few hours a week and spend the rest with family. That was his blueprint. The slow FI approach is another path. Someone in their 30s pays off all debt, builds multiple income streams, and then downshifts to part-time work they enjoy at 40 because they don't need full salary. They're not fully retired but have freedom to work less while still growing wealth slowly. 9697. My own composite case. The Garcias in their late 20s had $0 net worth in 2018. They made a plan to be work optional by 2030. They tackled high-interest debt first, then used combined incomes to live on one salary and invest the rest. They house-hacked a duplex. They steadily invested in index funds and bought 2 more rental properties over 10 years. By 2030, at age 40, they have their duplex plus 2 rentals yielding positive cash flow and about $500,000 in investments. Their expenses are modest. At this point, rental income plus a small withdrawal from investments covers expenses. They achieve lean financial independence. They both quit their corporate jobs and choose to do part-time passion work, which also provides some income as buffer. They reach their goal through a multi-pronged blueprint: frugality, real estate, investing, side income, each piece we discussed. Blueprint elements typically includes a clear vision of your end state, a target FI number, a timeline, 15 years, 10 years, etc., and the strategies to get there. It also means knowing your why. Freedom for what? That why motivates you to stick to the plan when it gets tough. 13 action steps. Crafting your freedom blueprint. Define financial freedom for you. Write down what a free life looks like. Does it mean quitting all work? Or just not worrying about bills? Or being able to start a charity or travel 6 months a year? Be specific. For example, I want to have $1 million invested by age 50, which should throw off about $40,000 a year, enough to cover basic expenses, so I can choose work I love regardless of pay. Or, we want to be debt-free with a paid-off house and $500,000 in investments by 45, so we can semi-retire and sail around the world, working occasionally online. There's no wrong answer, but clarity helps. Only 29% of Americans think their American dream is likely for them. Make yours concrete so you can become one of those who do realize it. 9495. Calculate your FI number or goal net worth. based on your vision. Calculate how much net worth or passive income you'd need. If you plan to live on $50,000 a year without working, using the 4% safe withdrawal rule, you need about $1.25 million invested. If you expect other income, you can adjust. Or maybe you prefer a multiple of income approach. Some feel rich or free at 10x their annual income saved, or having all expenses covered by passive means. Whatever metric resonates, put a number on it. It's okay if it seems huge now. It gives you a target to work back from. The median feel financially secure number Americans gave was $150,000 income, or a net worth of $500,000, but again, it's personal. You might lean more on creating passive income streams. 9893 Assess your starting point and gap. Take stock of current net worth, savings rate, skills, etc. If your FI number is $1 million and you have $50,000 now, gap is $950,000. If you're investing $15,000 a year, how long to get there at, say, 7% growth? Maybe that timeline is fine. If you want faster, you know you need to up savings income. Use online FIRE calculators to play with scenarios. If I save $X per year and invest at Y%, I'll hit $E by year. That can tell you the savings rate or side hustle income needed. For instance, maybe you realize at current pace you'll hit goal at 60, but you want 50, so you plan to boost income by $20,000 a year or cut expenses to invest more. This quantification turns the dream into a plan with levers you can adjust. Integrate all pillars. Your blueprint likely needs multiple angles. Expense management. Continue living below means. Decide a target savings rate. Many FIRE folks do 50% plus. It's okay if you start at 20% and work up. Outline major expense reductions. Perhaps plan on geo-arbitrage at some point as part of blueprint if that's in your vision. Income growth. Map how you'll increase earnings to fuel investments. That could be career advancement, or it could be building a biz or acquiring passive sources like rentals or royalties. Likely a mix. For example, in 5 years, develop 2 rental properties generating $X, meanwhile grow salary to $Y through MBAs, certs. Also invest in dividend stocks for $Z passive income. Many streams, one river. 22 Investing strategy. Choose a path. Many do simple index fund investing. Some incorporate real estate heavily. Some might aim for owning a business they can partially step away from. Write down your plan, e.g., max out 401 and IRAs annually in index funds, reinvest all dividends. Additionally, every 3 years, save enough for down payment on another rental property. Aim for portfolio of 5 rentals by 2035. Diversification is wise. Multiple asset classes provide more secure freedom. Milestones and timeline. Break the journey into milestones. By 2025 in 20 net wordt 100. By 2028, 300K and 1 rental. By 2032, 700K and 2 rentals. By 2035, $1 million plus net worth yielding $40,000 a year, enough to semi-retire. Celebrate milestones. Each is a mini freedom. Build in flexibility and backup plans. Life happens, recessions, health issues, etc. A good blueprint acknowledges risks and has contingencies. That might mean having robust insurance, an oh-crap fund aside from investments, and willingness to adjust. Also, consider partial freedom. Maybe you reach Coast FI. The blueprint isn't rigid. Think of it as a living document. Lifestyle design. Financial freedom is a means to an end, so outline how you'll use that freedom. Many FIRE retirees advise, retire to something, not from something. So plan hobbies, projects, maybe part-time work you enjoy, volunteering, travel itinerary, moving to be near family, whatever. Knowing what you want to do with your free time ensures you stay motivated to reach it and happy once you do. For example, Mr. Money Mustache's blueprint involved community projects and raising his kid. He didn't just sip cocktails. Your blueprint should include pursuit of health, relationships, personal growth, money freedom supports those. Execute and review. Once you have this blueprint, execute year by year. Treat it like a strategic plan. But also review annually. Life may change. That's okay. Freedom Blueprint isn't contract. It's your vision that can evolve as you do. The key is you're being intentional rather than drifting. One more psychological insight. Writing down your goals significantly increases success probability. It keeps you focused during the grind. Revisit your why often. Also, avoid lifestyle creep as incomes grow. Each raise, funnel the extra to the plan. Naval Ravikant said, "Desire is a contract you make with yourself to be unhappy until you get what you want. If you keep inflating desires, you'll never feel free." Part of the blueprint might be practicing contentment and finding joy in low-cost living. Many financially free folks credit modest lifestyles as key. They freed themselves from the rat race of consumerism as much as from need for salary. 9994 Long-Term Outlook. It might take 10 to 20 years to fully realize the freedom blueprint. But note, even partial progress yields increasing freedom each year. At 50% FI, you can take more risks, change careers, etc. Many find around halfway to their goal, their lives already drastically improved because debt's gone, savings cushion in place, perhaps working fewer hours or a more fulfilling job thanks to not needing maximum income. So don't think freedom is all or nothing, it's a continuum. By sticking to your blueprint, you join a minority. Remember, 77% Americans aren't financially secure, and half couldn't handle a $1,000 surprise. But you will systematically move yourself into the financially secure, then financially independent group. As Naval also said, financial freedom is freedom from money. The ability to not have to think about money. Ironically, you have to think a lot about money now to reach a point where you don't have to worry about it later. That's the trade-off. But once achieved, you get to focus on what truly matters to you in life: family, creativity, travel, community, without money chains. 3-100 in closing. Your wealth playbook started from beating a rigged system and ends with you designing your own system, one where you set the rules for your life. With the knowledge, strategies, and action steps from each chapter, and the overarching vision of this freedom blueprint, you have everything you need to embark on that journey. It won't always be easy and it won't be overnight, but as you've seen, ordinary people do it all the time. Now you can too. Your future self, living free, will thank you for the steps you take today. Go make it happen.